Bitcoin at 1 million US dollars is not a hype or any wet dream of some Bitcoin maxis. It's just pure math to get there. And today, Plan C, an absolute amazing Bitcoiner, is showing us why so many price models of Bitcoin are absolutely flawed and what charts and metrics we should actually look at when it comes to think where Bitcoin currently is. He's making the argument that Bitcoin is currently about 30% undervalued, and he's showing today in detail why this is and where we should be already. And he's also going into detail on when and why we're reaching certain price levels at like 400k, 800k, $1 million. And if you stick around till the very end of the podcast, we will also be talking about sports, diet, and a lot of personal stuff. But this is only at the very end of the podcast in case you want some bonus material. Enjoy. I think it also gives a lot of people conviction to see the charts and see the data, how it's actually there. I also like charts, but I really like to look at the fundamentals of like the narrative around it. I like going on narratives. And so I think it's always interesting when you have something like Bitcoin that has such a strong narrative, but then also such strong data. I think the first thing that you brought in today was this one. Am I right?
Yeah, we can start with that one for sure. And yeah, just totally agree with you. I think it's important to really understand the fundamentals. And there's a lot, just with the fundamentals without the data, there's a lot of conviction, you can get just by understanding Bitcoin at a deep level. And there's a lot that goes with that, right? With the fundamentals, it's also understanding just kind of how the world works in general when it comes to money. I mean, that's a whole rabbit hole in and of itself. But yeah, so the reason why I wanted to start with this chart specifically, and Smitston and myself put together an article on X that came out a couple of weeks ago that went pretty viral. And what it was, the kind of the purpose of that article was for us. We had many discussions ourselves. We're trying to understand, like, okay, what is the actual Bitcoin cycle, most correlated with? Are there things we can look to outside of Bitcoin and kind of assess correlation? And because there's a lot of opinions on X as far as like, okay, the 4-year cycle, different ways of analyzing the Bitcoin cycle. Like, it's a pretty hot topic, especially right now. People are wondering, okay, what's going on? Is, where are we in the cycle, so to speak? It's a common question that keeps coming up over time. And so as far as theories around the Bitcoin cycle, I mean, it's been so cyclical that a lot of people believe and are very convinced that it is a 4-year cycle, and that's just the way it's always going to be. And obviously, no one knows 100%, but it's interesting to kind of look at different ways of, okay, saying like, what is actually driving this 4-year cycle? What's logical? What does the data say? My current opinion on it is the halving played a role initially. So initially with Bitcoin, probably for sure the first halving, potentially even the second one, it was a significant driver of the cycle. My opinion is beyond that, it's really diminished in its effect. And it's not to say there's only one driver. It's basically a combination, right? You have a lot of different drivers that kind of combined in different weightings, right? It's not like one is the only driver. And so, yeah, I mean, with the 4-year cycle, it does make sense as far as the initial halving or two. A lot of people got attached to this 4-year cycle idea because of Plan B and the stock to flow model. That was really popular last cycle. And so as it gained popularity, the whole concept with stock to flow is to do with basically every 4 years, you have the halving event, and now there's, less supply, stock to flow, right? Less supply coming out relative to the amount of supply that's already been released. Now, I never really got, personally, the stock to flow model never made any sense to me. It just logically didn't make sense. I think it was a great attempt to kind of quantify scarcity and say like, okay, does scarcity drive Bitcoin? I understand why Plan B went down that route as far as, it's an interesting idea, and because Bitcoin is unique, right, with its 21 million fixed cap, it is unique on the supply side. And I don't get me wrong, Plan B I think is a very awesome, net positive to the space. He obviously brought a lot of people in last cycle with adoption and things. So, but I don't personally subscribe to the stock to flow model. I think it's heavily flawed. I just don't think it makes logical or statistical sense at all, and I think it's completely broken. So, yeah, we can kind of disregard that, at least in my opinion on it. Um, Moving on from that, though, this 4-year cycle has really stuck, and the reason why it's stuck is because it's a self-fulfilling prophecy to a large extent, right? So towards the end of this last year, a lot of this people selling, and I ran all sorts of different polls on my X account as far as like, do you believe in the stock to flow model, or do you believe in the 4-year cycle? And it was fascinating to see that like at least half of people, really do believe in it. And so what that kind of created in a lot of ways is a headwind, right? You have this headwind where self-fulfilling prophecy and psychology is that every 4 years, Q4, everyone sells, right? And then we buy back in a year later at the bottom, right? Because it's Bitcoin has been very cyclical. I mean, there's no denying that roughly every 4 years you have, Q4 is when the peaks have happened, 2017, 2021, you had the double peak in 2021, but it's been very cyclical. And then a lot of people are aware of this. Like a year later, we tend to roughly bottom out, right? So it takes about a year for full capitulation to happen. Then we bottom out. So, but we only have a few data points to this, right? As much as it seemed like this is the way things have been, people have to understand and remember that there's only been a few cycles. And statistically speaking, there's really not a lot of data points, and you can't really actually draw a lot of conclusions, because there's just not that much data with the cycle specifically. So my philosophy is to remain cycle length agnostic and look to possible correlated macro indicators. It's a combination of a lot of things, right? So with the business cycle, this is something that's gained popularity recently, because there is a strong statistical correlation with the Bitcoin cycle, and it's actually growing over time. So this chart is simply showing a z-score, standard deviations. It's normalized to basically the power law kind of long-term patterns of Bitcoin. So the long-term kind of trend of Bitcoin. A lot of people are probably familiar with the power law, but it's a way of normalizing the data to basically kind of show a fair comparison here. But you can really see visually, just it passes the eye test, right? We could talk about like R squared and correlation of things, but simply, visually, you can kind of see there's a correlation there, right? And so with the business cycle, I actually do think this has been one of the main drivers of the Bitcoin cycle. The business cycle, it fluctuates as far as the exact length of it, but it's been roughly around 4 years, the last few cycles, and so I do think, like I said, the halving played a role in the first couple cycles, because you got to think about this. Bitcoin was such a small market cap, and it had such low liquidity. It was such a retail-driven speculative asset, that the halving had a huge impact on the supply. It really did in the first 1 or 2 cycles. But that effect, by its definition, is becoming half as strong, relatively speaking, every single time, right? So that effect is going down and down over time. And at this point, it has a very small actual effect on the supply and demand. You can just prove that with math. Like it's just the effect now is so low relative to all the big players in the market and the market cap and the liquidity and everything happening. So the business cycle, interestingly, there's a lot of things I could say to this, but we might as well jump, I guess, to the next chart. Then I'll just keep moving on to the. Yeah, so this is a good visual here because it's another way of looking at it, right? You can really see that when we're below 50 on the business cycle index, typically that's not when the bull runs have happened, right? And we've actually never had a full bull market where we've had our complete cycle where we've been below 50 the entire time. And what you can see is the last 3 years we've actually spent the most amount of time below 50. So essentially, this entire bull run that we had, I call it a quasi bull run, right? Or a pseudo bull run. This bull run that we've had over the last 3 years since we had the low in November or October, I think it was, of 2022. Since we put in that low over 3 years ago, the actual macro backdrop as far as the business cycle goes, we've been below 50 essentially this entire time. We only recently popped above 50, which is basically expansion. So you have kind of contraction cycles and expansion cycles with the business cycle. And the expansion cycle, we got follow through. So we had our second print. It only comes out every month with the business cycle data. The last two were over 50. And before that, we only basically kind of got to 50, slightly above it for 1 month, like barely above it. I'm talking like 50 point a few above it. And then we went right back down. So we've basically, this entire last 3-year bull run, 3+ year bull run, happened in a macro backdrop that was different than every other point in Bitcoin's history when you look at it through the business cycle lens, right? And so there is something different happening here. And there's obviously a lot of questions, remaining to see what happens. But I mean, part of the theory is as long as the correlation holds, which the correlation's only been getting stronger. I can show that on the charts coming up. That makes me. It doesn't guarantee obviously that Bitcoin's going to go up, but what it does is it becomes a tailwind, right? So instead of a headwind, it becomes a tailwind. So it's one of multiple other potential tailwinds, right? You can have huge announcements that happen with Bitcoin, that drive FOMO and excitement. There's many tailwinds. Obviously, there's headwinds when you have global uncertainty, global fear, other markets, S&P and stocks and things, not doing well. There's some correlation with the stock market. So all these things can be headwinds or tailwinds at various times, but this is a clear correlated one that is basically flipping now over the last 2 months to become more of a tailwind than a headwind. But yeah, I don't know if you wanted to if you had any questions specifically on this chart before we jump to the next one, or just your opinion or any ideas or your thoughts.
Oh, yeah, I have a lot. But I think I want to start off with this halving thing, because you mentioned it, and I always I don't like the question of how much impact does the halving has, because it doesn't have this much of an impact anymore. If you think about how many Bitcoin are we mining per day, roughly 450, I think we are this cycle, if my math is correct. And I just looked it up today just because Seyr bought another Bitcoin chunk, how many Bitcoin he bought in 2026 per day. And the number is 974 per day on average that he has bought so far in 2026. And so if you have one company buying twice the amount of the supply coming new into the Bitcoin, how much impact does that new supply even have? I don't think it has that much of an impact whatsoever on the actual market. More about the psychology of it, we're having now the new supply, but we're already at 20 million roughly Bitcoin mined. So it's there's not that many more coming anyway. So I don't know. This question is just it's more psychology, the impact of that, and less actually an economic impact. Is that a fair assumption?
Oh, 100%. And I think it's good to highlight this, the halving, because I think it's important for people to kind of look at this just logically. I can basically kind of show this just through a logical lens. So, I mean, Bitcoin, initially there wasn't a lot else to be excited about, right? So the halving event was a massive deal back in the day, right? I can only imagine when Bitcoin was, a few $1 billion or whatever, it was so small. The halving event was huge. I mean, and the supply was being cut a significant amount. The inflation was being reduced a significant amount for the first two halvings, right? And so there wasn't much else happening. Now we have a lot of other, big adoption announcements that happen throughout the year. There's a lot of big events related to Bitcoin. There's a lot of news. It seems like daily sometimes you have different types of adoption news coming out that are huge, right? And so it's just not as big a deal to halving, relatively speaking. It's just not as significant from a news standpoint, a narrative standpoint, and a mathematical standpoint. And just stock to flow right here, I'll just put it to bed. Does it make sense that the supply goes from 1%, I'm just throwing out a number, from 1% to 0.5% increase in inflation, and the asset becomes 10x more valuable, that doesn't make any logical sense. I mean, you can, it just doesn't. Like, so like the difference between, 0.5% inflation and 0.25% inflation makes it now, $100 million instead of $10 million, or 10 million instead of 1 million. It doesn't make sense. The idea is like every 4 years, the halving supply halves, and now the asset's worth 10x more. There's no logic to that. It doesn't make sense at all. So I do think it's directionally correct, because Bitcoin goes up and to the right. So almost any model you make that makes Bitcoin go up and to the right looks directionally correct. But over time, there'll be more and more deviation from that model. We're already seeing that. For people that still believe in stock to flow, stock to flow says the average price between the last halving and the next halving is supposed to be $500,000 per day. So that's the average price, right? And so for every day you spend under that, you have to spend a day above that to an equal degree. So the average price is supposed to be 500,000 over that 4-year window between the halvings. And there's standard deviations. So that's actually goes as low as 250 to a million. So at the very minimum, to be within, I think it's one standard deviation, maybe even 2 standard deviations, basically Bitcoin has to average price of 250,000. So yeah, I mean, it's just not the model to use.
Yeah,
and people are going to be perpetually disappointed. I think it's important I think it's great to have, it's kind of tough as an analyst, because you can put out stuff that's more bullish to get views, but at the end of the day, it's disingenuous. Like when you understand the data, like it's like, I can come on here and spew hopium and it'll do better. I'll get more attention. You'll get more attention, probably get more views. But I think there's a good percentage of people that just like Bitcoin's bullish enough that when you present the data, you don't have to inflate it. You can just present the math the way it is. And I think it's important for people to have realistic expectations, because hopium, the thing about hopium is, yeah, okay, you feel great in the short term, right? Because like it's literally a drug where you're like, okay, you're seeing all these crazy bullish charts, and everyone's like super bullish, calling for $1 million like last cycle or whatever, this cycle or whatever. And it's like, okay, great, but there's a come down from that. When reality doesn't meet those expectations, there's a huge withdrawal from that hopium where people don't feel good and people get turned off. So I do my absolute best to present the data in a way that is just honest. I mean, I present it and I make mistakes. I've definitely made mistakes. I mean, I've always refining my models to try and understand things better. For me, it's a dynamic process of trying to further understand the best way to model Bitcoin long term. But I've already ruled out a lot of hopium charts and hopium models, and I've really narrowed it down to a way more realistic viewpoint. And that's also what I'm going to present today is a very realistic viewpoint as far as what the data says. So remove all the hopium if you're interested in like, okay, this is as best as we understand it today, what the math says, and these targets are actually fully realistic and not inflated based on the statistics. And it doesn't mean they're going to be 100% correct. I mean, we can overshoot them, we can undershoot them, whatever. No one can predict the future, obviously, but it's just a lens of saying, if all these patterns continue, this is what we expect, right? This is the highest probable outcome, or a reasonable ballpark, right? So that's all I'm trying to do. But yeah, sorry if you wanted to add something there.
Oh, I just wanted to make that, like, if we want to be actually in the 250, we would need to go very soon to the 400, 500,000 range and stay beyond that till the end of the cycle to even get to the 250 range, which is absurd. I like, there has to be a massive hyperinflationary situation outside of Bitcoin happening for Bitcoin to reach, like, it has more to do with the US dollar being printed away and hyperinflating than it has to do with Bitcoin's growth in general, I guess, then.
Yeah, exactly. I'm glad you said that, because that actually is the one caveat and the one thing I would say. In my opinion, the only way stock to flow holds as a model is if the US dollar completely like falls apart. Essentially, as long as the denominator remains stable to some degree, right? If we go hyperinflation, if we go, crazy debasement, and the US dollar completely falls apart, then a stock to flow will probably hold. But unfortunately, your purchasing power will still be, it won't be anything. So that's what really matters is purchasing power, right? We don't, I mean, you talk about this on many interviews, but stable assets, right? When you compare Bitcoin to something like gold, right? And we have alternative things we can compare Bitcoin to and change the denominator. I do like to use US dollars. I think it makes the most sense. I mean, there's not a lot of people trading Bitcoin for gold on a daily basis compared to US dollars and gold. That's what all the exchanges and all the market is based on. So I prefer US dollars. And the US dollar, my thesis will remain stable long enough that we can continue to model it in US dollars. But there are other ways to model Bitcoin as backups if we ever need to. I don't think we need to at this point, but I think that, like I said, as long as the denominator remains reasonably stable and doesn't get debased to nothing, then I don't expect stock to flow to work. But I do expect some of these other models to hold up quite well. But yeah, going back to the business cycle, I guess we can jump to the next chart here. If you want.
I just wanted to add one more thing to the business cycle, or like ask
Sure.
more or less, because it's really fascinating. The business cycle, is that just like also related then to money printing? So basically, we have kind of how did you say it, like distraction here, but like less money printing, less of the business cycle, and because we had then also less liquidity in the system, that's why the bull market kind of felt less exciting, because there was not as much money in the market, and that's why we have those voices saying, oh, like the Bitcoin price is manipulated, like all, and it's more like has to do more to do with business cycle and less to do actually with Bitcoin and the Bitcoin adoption.
Yeah, it's a combination of everything for sure. So I mean, it's definitely very complex, right? But there's a lot going on. I mean, you have I kind of look at it as a macro backdrop. So the macro backdrop is everything going on in the world, the financial world. Just global environment. You have global liquidity. You have, and there was a lot of charts for a while coming out saying like, okay, Bitcoin's very correlated to M2 money supply, and like liquidity and things. And the thing with a lot of these correlations is you have to assess, okay, are there legs with these correlations? You can kind of take charts and you can manipulate them in a way to make things look heavily correlated visually, right? So there's visual correlation, then there's actual statistical correlation, right? With the business cycle, what me and Smithson did in the article we put out is we looked at it through statistics and said, okay, what's the actual correlation here? Not just visually. You can look at stuff visually and it can look correlated, but then it's actually not deeply correlated. But yeah, I mean, as far as contraction, expansion of cycles, essentially, there's more like during expansionary financial cycles, you just have more money going around. Like there's more people are doing better financially. They have less debt. Their assets are going up, or they're just there's a lot of factors here, because you have to consider also what's going on, just with the Fed, right, and interest rates, and it all plays a role with loans and everything. But with the business cycle specifically, I mean, this is related to a survey essentially in manufacturing in the U.S. Heavily. And so, if there's a lot of new orders coming in and things are looking really good, and I mean that does relate to how the average Joe is doing in society, right? If there's a lot of people, if people are buying a lot of stuff still, then they probably have more money, right? And so then there's more money to go around, and so it's all correlated and connected, but there are different. They're not like fully correlated, right? So, business cycle in and of itself is its own beast. And then there is, a correlation with liquidity as well, but they're not completely correlated for sure. So there are aspects that are correlated, but in general, like to keep things simple, I mean, you just have a favorable macro backdrop in different aspects, right? And there's people, and I'm not a macro expert at all. Like it's definitely not what I focus my time on. I mean, there's a lot of very, very smart macro people out there that I listen to, and that would be better suited to speak to that specifically. But what my focus is on is, okay, what can we kind of look at where we can actually find these correlations? and do deep dives on. And the first one, I mean, I still have to look into other ones like global liquidity and things like this. I mean, Smithson will do that for sure, but the business cycle was kind of the first one we tackled, and it was really cool to see that correlation and the fact that it's growing. And it does seem to be one of the biggest drivers of the 4-year cycle, specifically for Bitcoin. For whatever reason, I mean, I'm sure there's specific reasons. I don't know all the details on all the reasons, but it does, yeah, it does seem to be heavily correlated. So I'm not sure if that answered your question or not, but yeah, it's basically when you're over 50, it's kind of expansion, and you're under 50, it's more contraction. And it's not the full picture on macro, but it's one of the lenses you could say, or one of the aspects, right? And sometimes these things can go in opposites, right? You can have the business cycle. A lot of times they're correlated, like I already said, but you can have different aspects of macro being headwinds, different aspects of macro being tailwinds, and you can have multiple line up in a positive way, so it can vary. But this cycle has been very different. I mean, the fact that we've remained under 50, it's important to highlight this. This is the only cycle in Bitcoin's entire history that the business cycle has remained under 50 the entire time up until just the last 2 months. And so if we've already completed our full bull cycle, it would be the first time in history that we had the full bull cycle during a unfavorable business cycle backdrop. And so that could be the case. I mean, we could have 100. This could just be the first time. Okay, it was just different. We did a bull run, and we didn't have the same favorable business cycle. Things did feel different. I mean, you've been here for multiple cycles. Like, this cycle got euphoric to a degree, but it was nowhere near what we saw in previous cycles, and it was not nearly as much retail. I mean, we had a bit of craziness in the meme coin space. That was a bit bananas. But as far as overall in crypto and Bitcoin, we never saw nothing close to as euphoric. We never had the very parabolic parabola top. It was more of a distribution over a year where we just kind of sold off above 100K. So there was in a lot of ways it did feel different. I don't know what your thoughts are on like how different this felt. And again, that's why I call it a pseudo bull run, or it's a quasi bull run. It was a bull run. No one can deny that going from 16,000 to 126 is a large increase in price, but we didn't have all the drivers that would get us to that crazy 2017 run or 2021. It was so much more euphoric and very different in many ways.
When I hear that, I'm even more impressed by what Bitcoin did the last 3-4 years. Like, if you think about what we did, not only just like from the price action, we crossed through the 100K, we crossed I think like 126 or whatever the highest point of Bitcoin was impressive, and especially considering the macro picture that we had and all the fundamentals with institutions are buying, like all of those things. And it makes me now think of, so I'm a big fan of like Larry Lepar, Lynn Alden, and all those theses that the nothing stops this train. There's a big print coming, like in that direction. And then I'm thinking, okay, we kind of have been like a low business cycle. It seems to me, without being an expert in macro, that we have to pop off the business cycle again. That there's like, it's just a matter of time that the business cycle really like pops off again, and we're putting the money print on, and like there's some reason why we print. Maybe war is the reason now. 2020, the reason was we are shutting down the whole economy because there's some virus going on. Like there are always some reasons to print a lot of money, and it seems to me there is something coming with the business cycle again, whenever it is coming. And then the question for me is, what will that do to those all those amazing fundamentals that we've seen building up in Bitcoin over the last years, when the macro picture is also kind of aligned with that? Do you follow?
100%. And that's exactly the way I look at it. We've had a lot of really positive things over the last few years when it comes to the adoption side. And that's why I think a lot of people are confused or frustrated, is it's like, oh, there's all this news all the time on X and on social media about all this great adoption news related to Bitcoin, right? We've had a lot of these exciting things that have happened over the last few years. related to Bitcoin specifically, and there's always a lot of future promises and things of like, okay, this could potentially happen, or this is getting closer to happening, right? So on that front, it's been very positive. But and the price, like I said, I'm actually impressed at how well Bitcoin did do over the last couple of years, for multiple reasons, right? So, and I think sentiment would actually be quite different right now if Bitcoin had just grinded up to say 60K over the last 3 years from 16,000 and never went up to like 126 and then back down. If we just slowly ground up, that would have actually made more sense with what the business cycle has done, in a lot of ways. So we actually did very well. I mean, the ETF was a huge, was a massive adoption thing, and a lot of excitement around that, obviously, and everything Saylor's doing, and there's a lot of other things, right? So treasury companies and such. But I mean, so there's a lot to be excited about. But yeah, just the fact that we did as well as we did, right? So given that we didn't have all the favorable backdrops of macro that we had in previous cycles, right? And it does seem like things have been extended to varying degrees. It's like, okay, it's taking longer to kind of for everything to align to have that full kind of bull run, right? And we've already had, you could say some amount of a bull run, clearly, right? I mean, you can't deny that. But have we had the full euphoric bull run? I'm not convinced. I'm really not convinced. And I've been saying this for such a long time, and I expected to see a decent correction kind of mid-cycle, and the reason why is because the four-year narrative is so strong and it's such a self-fulfilling prophecy that I expected there to be a lot of sell pressure come Q4 of last year. I definitely didn't think it would drag the price down as far as it did. I think there's multiple reasons why we ended up going as low as we have. I mean, there's a lot of fear in the world with global, wars and things like this. You also have the Binance quote unquote glitch that happened. I mean, that was a black swan that I don't think a lot of people talk enough about. I mean, you had almost 20 billion in liquidations. It was insane. I mean, what happened with Binance and that glitch caused cascading effects across the market, and it did bring the price down lower than it would have gone. I don't need to like speculate too much about, people can speculate about that black swan or whatever happened there. That's not as important as the result for me. The result is that a ton of people that were heavy long got liquidated in crypto and in Bitcoin. Because everyone was like, okay, Q4, we're always supposed to pump in Q4, everything's going to go up. And everyone went long. And then you had this glitch that happened, and it coincided with Trump, tariff news. And it just caused this insane liquidation across the market. And so I think that was huge. There's also a lot of speculation around Jane Street. I don't really want to get into that. I don't know. I don't think anyone knows what, if anything happened there, but there's a lot of smoke with that, and potentially there's something there. So, you have things like that, potential manipulation. You have the Binance glitch. You have the heavy headwind of four-year cycle psychology and the self-fulfilling prophecy there. And then on top of that, you have a lot of long-term holders, very long-term holders. And Checkmate's done a great job of showing this. A lot of these long-term holders, you can clearly see on chain that have held for a long time, hit their targets, and that 100,000 psychological target is huge. And there's a lot of people that just took profits. I mean, there's a lot of OGs that got in, and you can't necessarily blame them. I mean, they hit their targets for lifestyle change, and they basically took some amount of profits. Some sold more than others, but that was huge. You had a ton of older coins changing hands, which long-term isn't a bad thing. I mean, those are coins that are being distributed now, more decentralized to more individuals. And basically the cost basis of the network is going up. So you have, as those older coins with lower cost basis sell, you actually increase the realized cap of the market. So the market cap for Bitcoin becomes more legitimate. I don't know if that makes sense. Like basically, if you take all the coins in circulation and you look at when they were last moved or where they were last bought and sold, you have kind of like a value they traded at. So you can have a market cap, but then there's also a realized cap where you actually say, this is more legitimate because the coins have actually moved at these prices. So as all those old coins that were bought at like $1,000 or even less, they get bought and sold, at 100,000 or whatever, you're basically you're making it so that market cap itself is more legitimate, if that makes sense. So we went through that process as well. To summarize that, we had these long-term holders that took a ton of profits. So for all those reasons, the fact that we have held as well as we have is actually pretty remarkable. And my base case and my thesis is that we would see about a 50 to 60%. You call it a correction, you call it a mini bear market, you call it a bear market, whatever you want to call it. We've had a significant correction, but up until this point, and obviously it could go lower, but it hasn't resembled previous cycles where we went down, closer to 80, 90% initially, and then closer to 80% the last few cycles. So I do believe we won't see that like 80 or 75% drawdown. Of course, we could see some insane wick because of global events, just like what happened with COVID, where we had this like insane short term wick down. But I don't know what your thoughts are on that, but it's a whole topic in and of itself. But yeah, I'm more in the camp of 50 to 60% correction. We've already hit that range, and we've already gone 52. So we're kind of at that point. 60% would be 50,000, right? So that would kind of be, that's kind of my range. But I don't know if you have any thoughts on that specifically. I'm kind of jumping all over the place here now, but yeah.
The most effective way to buy Bitcoin is to DCA, dollar cost average, or ECA, euro cost average, into your Bitcoin position long term with the Relai app. It's the consistency of buying every day, every week, every month that compounds and really builds the position that you want to have in Bitcoin. And for that, I'm using Relai. Relai is Bitcoin only. They do not do any shit coins. They do not do any cryptos, any stocks, or anything else. This is a tool, an app, the biggest one in Europe, that is fully focused only and solely on Bitcoin. Relai is also self-custodial. So from the first second onwards, where you buy the Bitcoin on Relai, they are in your self-custodial control. They never have the keys to your Bitcoin. No freezing of your assets, no counterparty risk, no rug pulling whatsoever. And honestly, it's the simplest app that I've ever used in the whole Bitcoin ecosystem. Super easy to set up and super easy to buy your Bitcoin consistently. So set up your DCA and use code Robin to save fees and get cheaper Bitcoin. I want to tell you about something very special to me. It's called Microseed. If you hold your Bitcoin in self-custody, and you should, you know how critical it is to secure your seed phrase. You should not have them on paper. You should not have them on anything else than titanium. With Microseed, you can engrave your 12 or 24 word seed phrase, the entire seed phrase, onto a 1-inch small washer. Yes, just one washer. All 24 words on that one washer. You can hide that thing everywhere. And even better, you don't need to buy a new kit every time you have to get a new wallet. You can make unlimited backups because Microseed is not selling the washer. Microseed is selling the device that stamps the washer. So you get the full kit with the device, with the washers, with the hammer, with everything you need to get started today, and you can make with that unlimited amount of backups. Go now to microseed.io. Finally, we have BTC Prague back in 2026, and this year I'm not only speaking on a panel, but I'm actually going to present an interesting new angle, a perspective, a Bitcoin thesis at BTC Prague this year for the first time ever. I've never done that on any other conference, so this will be a fun one. If you listen to this show on a regular basis, I would love to meet you in Prague this year. It's very high signal, no noise, and Prague is just a freaking amazing city with awesome drinks and a lot of good food. Use code Robin to get 10% off, and if you buy with Bitcoin, you get an additional 5% off your ticket price. I'll see you there in Prague. I don't think, like, we've seen how much resistance there is with the 60K already. I would love, just for like the meme again to hit 58K. I like, just like, if we hit the 58K again, and we had a meme once before that we always hit the 58K and that meme comes back in reality, I think that would be hilarious. And I would love to gobble up some Bitcoin again at 58K. I think I even have like some stop thing going on. Like if it goes to 58K, then I buy some just to have the screenshot and the in the meme going on. But I have a hard time seeing Bitcoin even falling to those price ranges, because there's now so many institutions that seem to really love Bitcoin under 70K. It's I mean, we are right now under 70K, but I don't know how long we stay there. There seems to be a lot of demand.
Oh yeah, I mean, and the interesting thing is that, well, the first thing, based on what you just said, yeah, 58K gang or whatever was a strong meme for quite a while. I guess that was it's yeah, time is weird, but that'd be like 2023, I guess, or something. It's hard to remember now, but yeah, actually, the well, there's many popular kind of bottom indicators or bottom things we can look at. But the 200-week moving average is a common one a lot of people look at. And that's actually, I believe, right now around 59, 58K. So the 200-week is basically at that point. And we've bounced off the 200-week in a lot of cycles. We've got there and we've bounced off of it. We did go through it last cycle, and we did go through it during COVID. So it's not like we can't go below the 200-week moving average. We absolutely can. And last cycle, during the FTX lows, we actually went quite a bit below the 200-week moving average. Now, it took a pretty insane black swan for that to happen. So the 200-week tends to be a reasonable point where you can say, okay, most likely this is nearing a bottom on the TA side, unless we see, a crazy black swan coinciding with the kind of the cycle low or the correction low, whatever you want to call it. So there's a lot of indicators, right? I mean, I could rattle off so many. There's, you could look at, the 200-week is one. You could look at RSI. I mean, on the weekly RSI, on the 2-week RSI, 3-week RSI, whatever lens you want to look through, we basically reached equivalent lows of all the previous bear market bottoms. We've already done that, right? So RSI oversold. We kind of saw reasonable comparisons to every other previous bear market bottom already. And we'll go through some other charts here, which I'll show some other models for why I think we're pretty much at the bottom or close to it. And you can kind of see the confluence, and that's the thing. Like, I like to look at confluence, so not just look at, you can look at on-chain data, TA. You can look at statistical models. There's many lenses. You can look at production costs of Bitcoin. There's many ways you can kind of, and when you look at multiple different categories, the confluence to me is stronger than if you're looking at 10 different TA models, right? When you're looking at different lenses in different categories, I find that confluence is more interesting and reassuring, or gives you more confidence. But yeah, just to wrap up on the business cycle, you can see there has been a trend up. So basically over the last 3 years, there's been this trend up, slow grind up. Sminston is a phenomenal account, a good friend of mine, and he's put together a lot of these charts. We've discussed them. Yeah, he's great. Definitely follow him if you guys aren't already. And with this one, I mean, he's highlighted and spent a lot of time looking at the business cycle, and we've talked about it quite a bit. But with this, you can see over the last 3 years, it's been, he called it kind of a crab crawl, right? A kind of crab bull market, crab crawl. So a slow grind up, right, with this PMI. But what we got like I said, this isn't updated as of February. We actually had a comparable print. So we got confirmation. We got at least two. It'd be nice to get at least 3 to kind of get full confirmation that we're above 50 and going to stay there. But we've already printed above 50 twice. But the point of this chart is just showing it was a slow grind out for 3 years, and then we had a big jump. We went from, I think it was around 48 up to 52.6. And then the last I can't remember the last print, but it was really close to the one we did in January. February was pretty comparable. So that's pretty much it to show, but we still obviously can go a lot higher, right? And we've typically gone 60, 65, kind of more during the euphoric peaks of the cycle. So, but it's positive momentum on this kind of this one metric, you could say. But yeah, we can jump to the next one, and that'll wrap up the business business cycle here.
Yeah, I just want to add, because we talked about the bottom, and people always seem to ask about like, oh, where's the bottom and all of those things. And I would say, if it matters for you where the bottom of Bitcoin is, you're doing it wrong. And I want to get your opinion also on that, because what I mean by that is, if you somehow have your stacks set up in a way where you might get liquidated at some point, or you have some problem with paying something just because Bitcoin is going down. You're playing the wrong game in Bitcoin, because Bitcoin can always go down further. Even though we say like there's like resistance around 60 and like it's less likely, Bitcoin can surprise us. There can be like black swans and all those things. So I just wanted to add here, I always prepare my life set up around Bitcoin for the worst possible bear market up to come. So I'm still fine in that situation. And if we're ripping this year, like, I'm preparing myself for like a 30K price point. But if we are still ripping to like 300K, I'm also fine with that. And so, like, I think it's important to set yourself up in Bitcoin in a way that you can withstand those massive drawdowns that sometimes happen. And like, who knows, maybe Binance goes bust this year. I don't think so, but like, that would be a black swan, probably gets us to 30K.
Yeah, I do agree with that, and I think it's important to highlight this. I mean, and I do this with my own finances. Like I don't take any leverage at all with Bitcoin, because, like we've seen with these sort of things that can come out of left field, right? There tends to be, the market tends to go to the point of putting a lot of individuals in pain, and when a lot of people get over leveraged, I mean, you're setting yourself up. For just for a bad situation. I mean, anything can happen, right? Anytime you have leverage, you're taking on a significant additional risk with Bitcoin. And so for me, I've just hold spot. I mean, that's all I've ever done. I don't take any leverage, and I actually don't trade the cycles. The reason, there's many reasons for that, and I'm an investor. I'm not a trader. Basically, I'm a long-term holder of Bitcoin. I'm an investor, and at certain points, okay, you might take some profits when you hit certain lifestyle, whatever, take some lifestyle chips off the table. But my philosophy has always been basically more to do with, my philosophy is more along the lines of not trading the cycles, because I mean, some people will do well, of course. Some people will win. If you want to be a trader, I mean, there's absolutely people that'll do well. There's a lot of people that won't. It's a zero-sum game, right? And at the end of the day, when you factor in, paying taxes and all these different things, I understand there's options and there's things you can do for the really sophisticated people, but it's things can go against you. And I think, like with Bitcoin, I have enough conviction long term to just basically hold, and then based on different models, at a certain point, take profits when you hit targets, but don't expect to get back in. Like, basically, my philosophy is, okay, I might at some point I'll sell some Bitcoin, but not to trade the cycle, not to get back in, just strictly to upgrade my life in a meaningful way. And my thing is, people have this idea of, okay, just hold all your Bitcoin forever. And I get it. In the future, we can borrow against our Bitcoin. There'll be many ways we can use Bitcoin, but I do have a kind of a philosophy where, and you might like this, where Bitcoin is known scarcity. So we know how scarce Bitcoin is, right? There's 21 million. It's a scarce asset, but time is more valuable because time is unknown scarcity. So we do not know how much time we have. Nobody knows. And so time is, in my opinion, more valuable than Bitcoin. And so I put time as one of the few things, from a logical kind of asset standpoint, I put above Bitcoin. And I think you can make a very sound argument for that. Because I put time above Bitcoin, that makes me actually say, okay, I'm okay to trade Bitcoin during the higher quantiles at some point when I hit my targets for more time. And when I say more time, that can be, quality of life, meaning, okay, you're able to create memories with the people you love. That is like the most important thing for me, is like, okay, you can uh you can use something like Bitcoin to basically have those life experiences and take care of the time, which we don't know how much we have. And so that's my philosophy. I mean, it's an individual philosophy, but I absolutely am going to hold a lot of Bitcoin for a long time. But at certain points, my idea is, okay, when the cycle is high, when we're kind of euphoric and we're kind of overextended, but also once I've reached those targets, for me, there's no point in trading, every cycle. It's more wait a multiple cycles, wait till you get kind of to relative to when you got into Bitcoin, you hit certain milestones, just like a lot of these old, holders did last cycle, or like this cycle, basically, where they got in at 1,000 and they sold at 100,000 or whatever, right? They hit their targets. So that's my thing, is like, okay, hold until I reach my targets, assess when the cycle is euphoric, and then take some lifestyle chips off the table to improve my quality of life, and then hold the rest long term, right? That's kind of the way I look at it. But definitely taking leverage is a way to get wrecked. I mean, there's no question about it. I mean, a lot of people have unfortunately gone through that this cycle, especially with what happened with Binance. And so, yeah, and like you said, as far as like being obsessed with where the lows are and stuff like this, for me, it's more just a fascination and something to do throughout the cycle. I just love to kind of analyze things and I know there's people that trade and people that care. So I know that there's people that are like really interested in that, and it's fun to kind of speculate and talk about. But I mean, to be overly obsessed about it and be all out of the market, and you have to get back in when it's 57, and maybe we only go down to 58, and you never buy back in. And I mean, there's a reason why people DCA, right? I mean, there's all sorts of strategies and things, but just buying Bitcoin and holding it long term. I mean, people make things too complex, and they create all these different strategies to try and beat it, and most people won't. Like the vast majority of people will not just beat buy and hold Bitcoin long term. Like that's just the reality. Like over 90% of people or more will probably not just beat someone that buys Bitcoin and just holds it for multiple cycles. It's pretty simple.
And coming back to your point of like time being more valuable, if you just DCA into Bitcoin, you can focus the time you save trying to time the market with your family, with your friends, with building something, with doing whatever you love to do with your life, instead of like analyzing charts or anything like that. I mean, if you love analyzing charts and like you do that out of like passion, then it's a different game. And it seems like you do that out of passion. You like to look at those things out of like, I really like to do that. And having someone like you say that actually you should DCA and just like dollar cost average in your Bitcoin, even though you look at all those charts and like kind of trying to predict where those things are going, I think is just proving the point that most people should just DCA and use the time otherwise.
Yeah, exactly. So like I'm somebody that looks at Bitcoin, charts and data full time for the last basically 6 years. And even with all that, all the things I've learned and everything, it's still basically, I'm just humble enough to basically admit, like, I don't want to be sitting and from a trading standpoint, there's different things here. It's different when you're educating yourself about Bitcoin long term as an investor, and you have a passion for looking at these longer term models and things. But that's very different than being a trader who is trading daily and looking at charts and stressed out. I don't have any of those stresses. In a lot of ways, the chart, the stuff that I do distracts me during the lower parts of the bear market and things like this, the corrections. Like I'm not phased at all. Like I haven't sold any Bitcoin. I've been through COVID, or I actually went heavily in during COVID, but I've been through FTX, basically multiple crashes, multiple things. And it just doesn't faze me because I just have that strong conviction, and I distract myself in a lot of ways by focusing on the long-term charts and things like this. So, but yeah, I can only imagine people that are just, I mean, I guess some people love it, but sitting in front of a computer, looking at wicks and like trading on the daily and just being stressed all the time, and you can't do anything. It's not my thing anyways. But yeah, we can jump back into some charts here, longer term charts. So what this last business cycle chart is showing is basically the correlation with Bitcoin and the business cycle, and is strengthening over time. So one of the things that me and Sminston did, it was basically an idea I had. I said, well, what if we look at the first half? What if we actually separate the data set? So we take basically the first half of the data and we say how correlated was the first half to the business cycle and how correlated has the second half of the data set been to the business cycle. And when you do that, the correlation has increased 3 times. So the second half of the data set, right, since roughly, I guess that would be, what are we at here? Like whatever, 2018, 2019. Since then, the correlation's been 3 times stronger than it was before that. And you can also see on this chart, you can see kind of the effect of the halving going down, right? You can see that's the dashed line. So you can see them going in opposite directions, right? You basically have the business cycle, even though it goes through its peaks and valleys, like it goes up and then it goes down. The trend, if you draw a trend line through the business cycle, the R squared is basically strengthening over time. It's up and to the right. When you look at that squiggly green line, if you draw like a trend line through that, it's strengthening. So the correlation with the business cycle is getting stronger at the same time as you have the halving going the opposite direction. It's mathematically becoming a weaker factor. And that's what that dashed line is showing. Every halving, that effect drops down, right? As far as the annual inflation rate percentage. So they're going in opposite directions. That's kind of what the chart is showing. It's showing that initially the business cycle wasn't a driver. It wasn't that correlated, right? If you look at the first, up until about 2016, there was very little correlation between Bitcoin and the business cycle. And that's when the halving was having its biggest impact. I mean, and since then, there was this crossover where we saw the business cycle kind of take over, and then basically the halving become less impactful. So I don't know if you have any thoughts on this chart. That's basically what it's showing. The article goes into a lot of detail, the one me and Sminston put together. It explains all these charts in detail for those that are really interested. They can go, check out the article. Just go to Sminston's account. You'll see it. Go to my account. You'll find it. But that's basically the takeaway. I don't know if you had any thoughts on this specific chart.
The most important thing for your Bitcoin journey is not buying Bitcoin, but it's how to keep them. And yes, you have maybe the right tools, but how do you actually go ahead and stick it all together so it's the most secure for you personally? Self-custody is a deeply personalized journey, and the Bitcoin way is helping you exactly finding that correct setup for you personally. They are also helping you with securing your own cybersecurity. And if you want to go one step above all that, you can even get a consultation for a Plan B residency. Go to thebitcoinway.com/Robin and you will get a 30-minute free consultation. I finally and officially mine Bitcoin. This is not just something to stack more Satoshis, but it's most importantly also to support the network. Individual miners are the ones that keep the Bitcoin network decentralized. And by the way, you get KYC free Bitcoin. That's why I use Simple Mining. I get an actual proper Bitcoin miner. They set it up for me. They repair it if it breaks down. And most importantly, they let me choose the pool and even connect my own full node. I'm completely sovereign and I'm completely in control, and I can sign up with Ocean, no account needed. I just give them a Bitcoin address and then there's mining going on. No KYC, nothing. So if you're ready to mine Bitcoin, go to simplemining.io, tell them you come from Robin, and let's mine Bitcoin together. I think I should show people just briefly Sminston's account. Let me just quickly do that. I have to stop that. I have to start that, and there you go. Because I think most of the charts are from you and him, and so and Sminston was already on my show, and I want to have him soon back on the show. So this is the guy that also makes a lot of those things for people that wanna check him out. But I can't, because I'm very lazy with my YouTube descriptions. So you will not find it there, but you can just like look at the screen and see his Twitter handle and go directly to his account. So just for people to see that.
Highly recommended, obviously, following him. I've gotten to know him quite well. He's a really cool guy, and he shares the same passion I do about analyzing charts. He has a very strong background academically as well, and he's great. Put out a lot of good content, so definitely check out his stuff. But yeah, that pretty much wraps up the business cycle. Like I said, people can check out the article. It makes way more logical sense than the halving being the driver. So I think this is also a very fascinating idea that a decent amount of people have been posting about recently, is this whole idea around cost of production. And for people that understand Bitcoin at a deep level, they understand that miners play a significant role in securing the network and just everything to do with Bitcoin, right? And I do think what's interesting is not the halving. What's interesting is actually the cost of production, as far as setting the floor or roughly approximating a floor for Bitcoin. Because a lot of commodities, and Bitcoin is a digital commodity, in my opinion, it's a network. Bitcoin is a network of networks, but it's also a digital commodity. And it's related to energy as well. It's an energy currency in a roundabout way as well. So there's a lot of comparisons. You could say it is unique in a lot of ways as well. But Bitcoin is, in a lot of ways, it's a digital commodity. And if you look at other types of commodities, you look at gold, you can look at oil, you can look at many other types of commodities. Very, very rarely do they trade below their cost of production. Extremely rarely. Like, we're talking less than 5%, in some cases less than 1% of the time, that gold and oil will actually go below their cost of production, right? And so Bitcoin appears to be very similar. Now, the hard thing with Bitcoin is it's very difficult to actually quantify the cost of production for Bitcoin. So different people have put together, different ways of trying to quantify that. And there's not an exact number. And it's actually unknowable, because we do not know. Like, we know about the public miners, right? So in the US, I think it's around a third of all of the hash rate is it's around a third to 40% of all the hash rate in the world is basically US public miners. And they have to disclose, because they're publicly traded companies, they have to disclose a lot of their costs and these sorts of things. So you can actually quantify the cost of production for that part of the hash. But there's a lot of cost of production that is being subsidized by countries, and who knows where it's being done in different parts of the world. And there's no way to know all the costs that go into that production. So all we can do is essentially get a range of an approximation. And for me, it's more of a band than a specific number. So this specific model was created by a guy named Paul. Maybe we should highlight his account as well. I'm trying to remember his last name, but anyways, it's another guy I met that's a really awesome guy. He's focused heavily on the cost of production modeling. Sorry, I'll have to get his specific handle. I don't know it off the top of my head, but this specific model, basically, he basically determined, okay, there's a very strong pattern here between cost of production and basically acting as a kind of approximate floor model for Bitcoin. And you can see that visually. So the top chart is zoomed in, and it does show just a specific number, but understand this is a range, right? This is a range. You can go up or down, 10, 15%, whatever, around 10%, you could say, in both directions. So say the cost of production is somewhere in the 60s, it's different for everyone, right? You have some people that are able to mine at 40,000 of Bitcoin, other people that are at like 70 or whatever, right? So there's a range. But if you look at everything in aggregate, if you take all the production of all the miners and you get kind of like average it out, and you obviously would have to weight it based on how much they're mining, there is a number that exists, but nobody knows it. So, but the approximate number is between, you could say between like 50 and 70, right? Is very, very roughly speaking, the cost of production. And it changes, like the cost of production changes. Some miners, they can't compete. Their costs are higher and they have to shut off, right? This happens every cycle. And that allows, the miners that are more efficient to get a higher percentage of the overall pie, right? And then that kind of brings down the cost. So this number is always kind of moving. The reason why it looks so flat on a lot of these charts is Paul is kind of smoothing out the data and showing it on higher time frames. This is actually weekly data, and then he smooths it. But I mean, just visually, what are your thoughts? Like, you can see the bottom one is the longer term view. The top chart is more zoomed in, and you can kind of see that, I put all these red arrows there, but you can see basically we kind of have bounced, roughly speaking, at this cost of production band throughout Bitcoin's basically full history, this has acted as support. And along with adoption, I do think cost of production potentially might be one of the things that explains the power law kind of long-term mathematical growth patterns for Bitcoin. But yeah, I don't know if you have any thoughts on this before we jump to the next one.
Yeah, I think it's very logical to see cost of production as kind of a base for what the Bitcoin price is. But then also, I guess there's a natural mechanism in there. If it's no longer profitable to mine Bitcoin, so like the cost of production of Bitcoin is higher than the actual Bitcoin value, it will be harder for Bitcoin miners to stay online and pay the bills. And so maybe then the difficulty adjustment kicks in and kicks out, basically gets the cost of production of Bitcoin down again. Do you have any thoughts on that mechanism of like, what if like the Bitcoin price drops so much that the cost of production is higher, and then kind of like the difficulty adjustment adjusts the cost of production down? If
it's all very related. It's all very related, and really, it's being factored into this this specific model. So actually, the way Paul created this, he has a really good article where he goes in and explains the specific math behind it. But he's actually only taking inputs from the actual Bitcoin blockchain. So difficulty is one of the inputs into this. Is also issuance is another input. So he has multiple inputs that are exactly speaking to what you're talking about. So he's not, this isn't created by going out there and doing surveys with all the miners in the world. Because like I said, there's a lot of miners that you can never survey that are not public or whatever. Black market, who knows? Like there's a lot of the mining that goes on that we have no awareness of. So, but this is done through difficulty, issuance, and there's a formula basically to kind of estimate this cost of production. So it is true. It is true. As like there's a point in every cycle where a certain percentage of the miners that have the lowest efficiency, they can't make it, right? They have to turn off at least for a period of time, or they might even go out of business because their costs of production are higher. I mean, there's so many things that go into it. You have electricity, you have just the location they are. There's a lot of factors, right? What miners they have, right? How efficient are their miners? Like, so there's so many things that go into this, and as those miners that are less efficient, it's a strong survive every cycle. That's just the reality of the way it is. There's a percentage of miners that their cost basis for mining is so low that as Bitcoin goes down back towards the cost of production, basically it's okay if Bitcoin goes down to the average cost of production. That's fine. They just don't want it to go below their cost of production individually, right? So as long as they can keep their cost of production below the average, they're doing quite well, because Bitcoin historically kind of goes back to that average. And it can go back even lower and squeeze more. It just depends on how much it's going to squeeze. Every cycle, there's some sort of squeezing that happens here. And sometimes it's more severe than others, but all the miners get squeezed to a point, and some more than others, depending on their position, right? And so that's all this is. It plays out every cycle, and it's healthy. It basically, we want Bitcoin to be decentralized as much as possible. We want lots of varying types of miners, but the reality is that you have to be an efficient miner to survive. And this model essentially is just highlighting the fact that we usually come back to approximate roughly around this band of the average cost of production for all the miners. And it makes a lot of logical sense. It's not just the math that shows this and the charts that show this. It just makes logical sense that Bitcoin wouldn't go way below its cost of production, just like no other commodities really do. And it's one thing to go there short term. It's another thing to stay there. So for Bitcoin to go, down to $10,000 and stay there for like 2 years, that would be very painful for a lot of miners. Yes, the difficulty would adjust. Yes, things would change. The cost of production would come down. A lot of miners wouldn't make it, but that would be extremely different than any pattern we've seen in Bitcoin's history. So that's basically, we can never, nothing, it's all probabilities. Nothing is certainty. So you can't say for certain 100% anything's going to happen. It's all probabilistic. Basically the lens that I use is just all based on probabilities, but we can look to the past and quantify roughly okay, what's the likelihood or the probability of these sorts of things occurring? And the more of an outlier they are, the lower the probability, essentially.
I like that. I like that lens a lot, and so it's like, and you can more and more you can basically gather more and more different inputs and different perspective on the same thing, and you see like, oh, cost of production or business cycles or all those things are or the 200-week moving average, I think also you mentioned, and there's like a bunch of other things, and you kind of put them all together and you're like, yeah, I'm certain that we are kind of at a very low price point for Bitcoin, but you cannot be for sure. It's just like collecting a lot of evidence and you kind of point towards that. It's, I guess, like solving a crime. You find a lot of like evidence for one particular thing, but unless you have someone actually seeing exactly what happened, it's kind of hard to say what actually happened.
Exactly. And I mean, it's, yeah, that's just the reality of analyzing data. You can't, no one can analyze data from the future. So all we can do is look in the past. It's funny when people say all these models are all based on the past. Well, of course they are. You can't base models on the future. I mean, it's unless you have a time machine, nobody can look at data points in the future. So yes, all data analysis is done based on past data, but there's a reason why we have all sorts of different scientific fields and ways. Like data is extremely valuable, and understanding how to analyze it. I mean, and there are these patterns, and there are very clear ones, right? So another very clear pattern is lower volatility. Anyone can essentially look at this. Just throw like a longer term moving average on volatility through Bitcoin's entire history. You can look at standard deviations. There's many ways lenses you can look at this through, but basically Bitcoin's volatility has been coming down since inception, and it makes logical sense because the market cap is growing, the order books are becoming more thick, right? It's becoming it's like it just takes more capital to move Bitcoin, and so yes, it's still volatile, but the overall volatility, if you don't just look at single days or short term or whatever, if you actually look at the full data set and you say, what is the volatility doing over the course of Bitcoin, it's clearly going down. And so because of that, that's another thing that basically says the network's becoming more stable. Bitcoin is a network that's gaining adoption, and along with that volatility going down, it's stabilizing. Another way to say that is Bitcoin is stabilizing as a network, and because of that, right? Again, going to this chart, okay, what's the likelihood we go, 80% below the cost of production? Well, it's less likely today than it's ever been because the volatility is lower than it's ever been, right? So the volatility goes in both directions. Yes, it means we're not going to have the returns we got in 2010 or 2011, most likely, unless the dollar breaks. But we're also not going to necessarily have the downside extremes that we've seen in the past. The volatility compresses in both directions. You can visually see this when you look at the upper parts of the channel and the bottom parts. You'll see on future charts we go into here that there's a compression effect in the volatility of Bitcoin. So yeah, this is another clearer pattern. I mean, okay, cost of production, roughly speaking, has always approximated the bottoms. Bitcoin's volatility over the long term is clearly going down. There's a statistical correlation with the business cycle. These are fundamental things that people can understand, and you can kind of start to put these pieces together and kind of give you a good holistic lens on understanding kind of what's going on with Bitcoin, right? Like you said, no one can predict the future, but we can use the past to approximate and kind of give a reasonable range of outcomes, right? So this, I really like this model. Basically, I created the Bitcoin quantile model going back over a year and a half now. And the lower quantiles are based around the power law. So basically, you've had Giovanni on your show a couple times, I think, and he was the person that basically kind of publicly has been the biggest advocate for the power law, and him and another guy named Matthew basically discovered the power law around the same time. But this, so with the quantile model, the really cool thing about it is you can basically say what percentage of the time have we been at each level. So you can actually use statistics to basically look at the full data set, and you can compare things relatively speaking. So you can actually compare at different points in time. And so with this, you have, I call it quantile deep value. So what I did is I just highlighted basically the first quantile to the 10th quantile. Just disregard that bottom line. It's like 0.1 quantile. We only spend 1 in every 1,000 days there, basically. So you can kind of remove that bottom one. But the first quantile to the 10th quantile, I have like the first column shows today. I put this chart's a month old, so some of these have all these numbers have ticked up slightly, but not dramatically. Like the first quantile now is around 55 instead of 35 and a half, right? So these have all gone up a little bit, but they're pretty close. 6 months into the future and 1 year into the future, you can see how these kind of bands and the price targets change. So for the first quantile, right, that's the bottom of that kind of blue band that you can see there. That's at 53, say 55. That's at 55 today. So what that means is we've only spent 1% of the time through Bitcoin's entire history below that kind of statistical point, that statistical band. And that's based on fitting, right? You can do different types of fits. This uses something called quantile regression. But what's important is more, you can kind of assess and look back and you can say, okay, what is this point comparable to, right? So we actually already got down. So this was a month ago, and I created this when we got down to around $60,000. So at that point, we got to the fourth quantile. So we already got basically a month ago, we already went down to the fourth quantile. And that means that we've only gone below that 4% of the time in Bitcoin's entire history. So we got pretty low on the chart. You can kind of see it visually on the right there. You can see we dipped into the band. And if you look where all the first quantiles were, you can see the FTX low, right? The FTX low went down to the first quantile. COVID went down to the first quantile. The bear market before that in 2018, we actually only went down to around the 20th quantile. So we actually it took basically a black swan to get us into the lower quantiles during COVID. And then the bear market before, you can see we got into the band. So basically this has acted as support. You could call it support the entire history of Bitcoin. And this is the fundamental power law. So we'll see in future charts that this potentially is also related to the cost of production as well. So there are different ways of kind of looking at the same phenomenon, but there's an underlying mathematical pattern that Bitcoin has followed. Yes, it's possible it could break. Anything can break, but it's the strongest pattern we've seen in Bitcoin through its entire history. And what I did is basically create a model around this where you can look at, quantiles 1 all the way to 99 or 99.9, and you can assess, okay, the bottom quantile is basically, you can look at it as deep value because you're buying in at a point where you only spend 1% of the time there. So by definition, your buying is better than 99% of Bitcoin's history, if that makes sense. So if someone's buying, but it doesn't mean we'll get to the very lowest quantiles. That's the thing. So, but the people that were buying at 60,000 at the fourth quantile, relatively speaking, statistically, they were buying better than 96% of the Bitcoin days in its entire history, if that makes sense.
Interesting. So it's kind of like a way to figure out how close we are as the other indicators that we've discussed, the moving average, the cost of production, all of those things. It's another kind of indicator where we are in the cycle.
Yeah, and it's completely based on math and statistics. That's it. Like there's no biases here whatsoever. This is just the pure math and statistics. So like when you look at it, you can assess, it's a way of comparing, right, current cycles to previous cycles from a statistical standpoint, right? You can basically say these are comparable points, even though the price is dramatically different, right? You can see the y-axis on the left there. You can see that's in log, right? So that's the price is logged. I display it in linear because it's a lot more intuitive for people to understand. Like you could make the x-axis logged as well, right? That compresses time, right? But humans perceive time linearly, so to me, it doesn't make logical sense to compress the x-axis. It would make like a power law. You would see, right? You would see more of a line through the bottom of the chart, or through the lower quantiles if you did that. but it's harder to understand when you do that. But the point is, like, this is, when you look at this visually, we're talking about going from 3 cents to $100,000, right? So like, if you didn't compress the y-axis, if you didn't log the price, it would be very hard, to see, relatively speaking, to see things in a way where you can kind of assess it, right? So what log does is it's able to compress, and then it makes it easier to compare things that are on different scales, right? When you have something that's at a cent versus something that's at $100,000, you have a lot of magnitudes of scales that you've gone between, right? A lot of people are familiar with like the Richter scale and earthquakes, right? You have a 7 or a 6. Well, a 7 is 10 times stronger than a 6 on the Richter scale of earthquakes. It's the same idea with this on the y-axis. You have, logged of price. So you can see, as we go up, it's all relative and it's compressed. But basically, that's pretty much it with this model. I mean, I really like it as a lens because it's another way of looking at things. It's very different than TA. It has no relationship to TA. It's pure statistics. It's pure math. And it's basically taking the full data set. I go all the way back to the very beginning. It starts in July 17th, 2010. That's when the first data point you can get when Bitcoin first started trading on Mt. Gox. So it's really the full data set, and I use hourly data. So it's actually 137,000 data points with hourly data. And it's basically just running all the regressions, and you're able to quantify, okay, statistically, these are the percentage we spent below different levels. And as you can see, basically right now, between 55 and roughly, 68, say, that's the bottom 10% of the data set, right? And so in that range, you're basically you're in the 10% that is the least euphoric of the entire cycle. Like, I don't know, there's many ways to say the same thing, but basically you kind of can assess, okay, like, we're really at a point where we've only spent a limited amount of time here throughout Bitcoin's history. That's one way of looking at it. And because of the patterns, you can see these numbers grow, right? The floor, kind of statistical floor, grows. So like in a year from now, the bottom quantile will be more like 77 instead of 55 or whatever, right? So yeah, we can jump to the next one unless you have any additional questions or thoughts.
No, it's just really fascinating for me because it gives to the feeling I have actual data. Like it's always good to, because I'm a very narrative and feeling based like person with a lot of the things that I'm doing, and with data and mathematics I always rely on smarter people. That's why I've had Giovanni on, I think 3 or 4 times already. I had Paula, people like Stephen Perrinard, I had him on already 3-4 times also. So like there's multiple people that I'm like, oh, that stuff is really interesting, and every time I have someone on, I'm learning something new. And so I just like find it very interesting to just listen and like see how you think about those things, and for me actually to learn something.
Yeah, man. And it's, I mean, I've been here long enough as well where you can kind of also you get kind of a feeling too during these kind of periods of the cycle. Like, there's very few times during the cycle where I'll get this feeling, and I know it's an indicator. You basically get this like roller coaster feeling in your stomach one day when the price is just dropping, and even if you have this high time conviction and this high like belief in Bitcoin, that's in your head. Your body still responds, and you still have that feeling in your more emotions in your gut. That's like, whoa. Right. And that to me is usually an indication that we're getting reasonably close to a bottom. But for me, I as far as the emotion stuff, that can be an indicator. I mean, you can kind of, when you've lived through these events, when you've been here through those events, you can kind of compare how you felt compared to like, okay, how did I feel during FTX? How did I, I've done, and I even did polls on my account. For people that remembered, I said, I did a poll somewhat recently. I think when we went down to 60K, I said, how does this compare to how you felt during the FTX? I made some sort of question like, how does this compare to FTX? And I was shocked that over 50%, it was pretty much split. There is a recency bias you have to factor in, where people are going to more heavy weight in a recent event as being worse than a previous one, right? It's just the way people are. There is a recency bias, so people are more likely to say what's happening now feels more extreme, because to a degree their feelings from the past erode away somewhat. But a lot of people that were here during FTX said this feels similar to FTX, which I thought was interesting on the to speak to your kind of more emotional, psychological side of things. But yeah, going to this chart. So what this is showing, it's related to the last chart I showed, right? So the last chart was showing kind of the floor through the quantile lens, and basically the first quantile. So what I did is I actually ran a very detailed analysis on how stable throughout the entire history of Bitcoin has that first quantile line been. And the way I did this, I don't need to go into everything, but I'll just kind of explain it somewhat. I actually took 522 weekly fits. So basically what I did is I went back 10 years and I did a snapshot going back every week over that 10-year period. And the reason why this matters is you're basically able to look at the stability of that first quantile. So that first quantile has something called a slope. And the slope is basically, it's just a mathematical way of basically quantifying the pattern. And it's saying for every amount of time that increases, the price goes up, this amount. So the math is less important, specifics as more the concepts here. And what that chart is showing is it's showing that Bitcoin, the bottom quantile, has basically been stable for over 10 years. Completely stable, like not just a little bit stable, but it's been basically at the same mathematical pattern, has basically followed almost exactly for 10 years. And the reason why I know this is because I ran all the analysis. I mean, I did 522 snapshots weekly on the exact math behind that fit. And the variance, the amount it changed over that course of 10 years was 0.37%. So the amount of fluctuations that the actual fit changed over 10 years was only 0.25%, right? So very, very small. You can see with the chart there on the left, you can see how it started very high, the slope, and then it came down dramatically, and then it just flatlined. You see what I'm talking about with the slope? Like basically you can see on the bottom, you have time. Like, so on the x-axis, you have time, right? Every 2 years, I'm showing. And the left, you have, going from 4 to basically 10. Well, that's the slope. And that really is what basically creates the pattern behind the quantile and the pattern we were looking at in the prior chart. But you can see, like, if this was going all over the place, like that would give you less confidence in the last snapshot of what we just looked at, the chart before, because you'd say, well, yeah, it looks good there, but it could move in a week to another point, right? But this shows that for the last 10 years, that pattern has not changed. Basically, the same growth trajectory has remained consistent for the last 10 years.
I love that, because it shows that so basically the line that we see here, the blue one here, stays consistent and is not volatile as it was in the beginning. Is that what you're saying?
Exactly. You couldn't have created this model back in 2014 or 2012 because there wasn't enough data and you didn't have a stabilized mathematical slope pattern yet. So it took basically the first 6 years of Bitcoin for it to stabilize. And now for the last 10 years, it's actually been a useful model. For the first quantile, every quantile is different, but the first quantile is the most stable. And basically, that's the bottom of that last blue band chart. And so what this is showing is basically confidence. This can give us an idea of how much confidence we have in that prior chart, because it's saying 55,000 is the first quantile based on today. But the reality is that the math that creates that, basically saying 55,000 is the first quantile, the math has been consistent for 10 years now. It's been extremely stable, and it's only fluctuated up and down 0.25%, right? And it doesn't drift either. You can quantify the drift. So it basically is a very narrow range that it stays within. And as new data comes in, that math updates, but the same pattern and the same trajectory remains the same. So that's really what this is showing, is it's highlighting I wanted to highlight basically the bottom quantiles and kind of show that. And the interesting thing, again, to go back to it, is the bottom quantile around 55. Cost of production, probably between around 50 to 65,000, roughly speaking. And then you have the 200-week moving average, 58, right? There's a lot of these similar numbers from completely different lenses, right? So, but that's basically it. We can, if you want to jump to the next one, we can jump to the next one. So this is really interesting, because a lot of people that are familiar with the power law, I mean, you've had Giovanni on your channel, like you said, multiple times. Everyone starts the power law pretty much from Genesis block. That's the consensus. That's kind of the that's always been the assumption, that this is when we should start the analysis from. But I actually want to challenge that very heavily, and I can back it up with math and statistics, that the Genesis block is actually provably not the best way to start the power law analysis for many reasons. And it does make a difference on some of the targets, and basically the model is way less stable when you use Genesis compared to other points in time. Now, a lot of people will initially push back on that and say, well, has to be Genesis. How could you use any other point in time? Well, Genesis is when the blockchain started. It's when Bitcoin's blockchain started. But Bitcoin itself came into being, you could say, as a process over a period of actually a year. For people that know the history of Bitcoin, I mean, first you had the white paper that came out, months before the actual, like the Genesis block was January 3rd, 2009. But the actual white paper came out in October, I think it was October 30th, 2008. So a couple months before. And then you had all sorts of other milestones where you had, Bitcoin, the first transaction, between Hal Finney and Satoshi or whatever, the first node coming on the network that made it an actual network, beyond just a database, basically one computer. Then you had all these different milestones. And then the first time Bitcoin actually was traded for US dollars was actually a year after the white paper, roughly speaking. So the first time Bitcoin, for people that don't know, Bitcoin got traded for US dollars on October 12th, 2009 was the first time it was ever traded. And it was $5 for this is before people think of Pizza Day. Pizza Day was the first time Bitcoin got traded for something in the real world, like for a good and service, you could say. But actually, that was actually quite a bit after the first time Bitcoin got traded for US dollars, which is what we're modeling here. We're modeling Bitcoin versus US dollars. So there's actually like a period of a window from Genesis block, or even from the white paper, all the way to the first time Bitcoin got traded for US dollars. That's basically a year-long process where until Bitcoin actually was traded for US dollars. So my argument is anywhere within that window is essentially you could start the analysis for comparing price versus time, because it wasn't like Bitcoin all of a sudden became something overnight. The blockchain was obviously huge when the Genesis block first happened, but that didn't make Bitcoin Bitcoin. It was a series of events over the course of a year. So when you compare the Genesis block right here, I mean, just to go back into the data, when you look at April 5th versus, and it's not exactly April 5th, you could say April 6th, it just roughly in that period of about 3 months after the Genesis block. Because when you do a power law, you have to look at the power law is price versus time. So for people that don't know, like with Giovanni, and talking about the power law, and people that are familiar with what the power law is, what you're looking at the price on the y-axis. You're comparing price, and then you're looking at time. So it really matters when you start time, because it's really the only input you control. You don't control the price. The price is just data you get on the exchanges. So as someone who's analyzing this basically model, the only thing you actually control is when you start time, and you do logs since a certain point in time. And everyone has always just done Genesis, and they assume this was the way to do it, but it actually doesn't create the best models. So just to go into this briefly, and we'll jump to the next one. On multiple metrics, you can analyze how stable it is when you use Genesis as the start point versus using about 3 months after the Genesis start point. And you can even see just the stability of the lines going back to the top. See how the green line is more flat versus the line above it? That line above it is using Genesis. The line below it is actually using April 5th. And so you can see the stability of those lower quantiles is more stable when you use a little bit later of a start date than you use in Genesis. When you use Genesis, it actually has been less stable, and quite a bit less stable. It's actually 3 times less stable on the variance, 3 times more deviation, and the range is actually 2.3 times wider. So on multiple metrics and ways of looking at this, it's a lot less stable of a model when you use Genesis than when you use a later start date. But you'll see in the next charts we'll get into. We can jump to the next one as well.
Is it, just a quick question, is it the later you would start that model, the more accurate it gets?
No, it's actually, so what I did, and I've spent months on this stuff, is to give you an idea of how obsessive and how much I enjoy this sort of stuff. I like to optimize things. So I obviously am a fan of the power law. I think it's a great kind of a lens of looking at Bitcoin through. But there's a couple things that I said, okay, is there a way to actually make this even better? And so I took every single day. I took all the way from the white paper all the way to the first time Bitcoin was traded in US dollars. So that's a full year period of time. So it's actually pretty much close to 347 days or something. I took every single one of those days and I ran the analysis across multiple metrics, across stability, across out of sample R squared. So I actually split up the data set. I looked at which predicted things better. So I looked at it through all sorts of lenses. And I looked at every single day. I had no bias. And I said, what is the day that creates the most stable model and the best predictions with the out of sample data? So when you actually, train the model in the first 2/3 of the data set, which predicted the last third, right? The best. And so when you do that, there's actually a big U shape where the optimized kind of point is around 3 months after the Genesis block. So it gets progressively better, gets to a kind of a point where it peaks, and then it gets progressively worse. So the more you go past April, the worse the model, the kind of the stability. It gets better, hits a point, gets worse. That's kind of the simplest way to look at it. So it's not just the later you start it, the better it gets. It's actually a specific period of time. And the interesting thing is April is roughly speaking in the middle of the white paper and the USD first transaction. If you look at that full year, right? Because the first time the white paper was October 31, roughly 31, 2008. Well, if you go 6 months past that, it's roughly speaking in the middle of that full year. So if you say Bitcoin basically came into being over a full year, the optimal point to start it is kind of roughly speaking in the middle of that window. So as you get past that point, it gets worse. As you get before that point, it gets worse. So that's kind of, if that answers your question. But we can, jump to the next one here. So this is just again showing that I ran like lots of different analysis. This is actually based on out of sample data. So it's not just looking at the in sample. So it's kind of the high, like in statistics, out of sample is pretty much as good as you can get when you're running analysis. So April 6th, you can see here ranked 1 out of 347 days. Genesis actually ranked 283rd. So it's not even close to the most optimal point. Like it's not even in the top half of the best days to actually run the start point from. And the interesting thing, if you look at the bottom chart, you can see this is calibration. So what this talks about is when you do the out of sample data, how many of the data points fell below that first quantile. So you'll see it on the next chart. We might as well jump to, I'll explain it a bit, but basically, this shows that this is looking at R squared, which is like the goodness of fit. And so with this, you can see, right, it kind of it starts really low. Obviously, the white paper is not where you want to start. It's the worst. So the white paper is the absolute worst. If you start the power law with the white paper, you're going to get the worst model, stability-wise and prediction-wise. It gets better. You can see Genesis, 0.87, but the peak is in April, kind of around April, and then it goes down over time. Now the drop-off isn't as severe as the beginning, but there's clearly a kind of a U shape here and an optimal point, right? So we'll show this in multiple ways. You can jump to the next one here. This one is really important for people to understand this. This is extremely important because one of the criticisms about the power law, and one of the criticisms about even the quantile model is, well, won't it just adjust lower if we go below it? So what I did here, for people to understand this, it'll make a ton of sense. So what I did is I actually took the first 2/3 of the data set. So I stopped the analysis roughly around 2020, a little bit before 2020. And I basically said, take only the data before 2020 and project out the fit for the next till the end of the data set. And what do you have? So these are both based on the first quantile. So if you use Genesis, that's the red line. If you use April 6, it's the blue line. And basically, when you only use the first 2/3 of the data set and then project out, if you use Genesis, it said the first quantile today was 54,000. So we're already went below that first quantile, right? You can see the red line. See how much we went below it during the FTX collapse? So we actually have spent 12% of the time below the first quantile if you start at Genesis, which is significant because the first quantile, you're only supposed to go below it 1% of the time. But if you use Genesis, we went below it 12% of the time over the last, third of the data set. So if Bitcoin is 16 years old, right, roughly speaking, since we have data in 2010, basically you could say, okay, so over those 16 years, we spent just over 5 years. So basically, if you take the first 10 years of data and you try to predict the last 5 years, right, you can see that the red line just didn't work. It had to adjust lower. So, but that's only the case if you use Genesis. If you use April, you can see it remained consistent and it's at 54. So Genesis had to readjust lower. So with the red line, the Genesis line, when you stop the data, like I said, it projected out to 74,000. Well, the reason today, the Genesis start point is at 58. So it had to drop down like 16,000, if that makes sense. So basically the line it's drifting. The whole model is not stable because what it projected out based on the first 10 years of data, it had to correct. Whereas the April start has remained the exact same the whole time. What it predicted 5 years ago, based on the first 10 years of the data, is the same prediction it has today, right? So hopefully that makes sense. Like basically the blue line has been stable and has not drifted at all, which is the April start. And the Genesis had to correct lower because we went below the floor. I mean, basically you could actually, based on this chart, you could say that if you're using Genesis to quantify the bottom, it already broke because we spent 12% of the last since 20 over the last 5-6 years, we spent 12% of the time below the floor. That's a broken model. So, I mean, this is basically definitive proof that if you're using Genesis as your start point, your model is suboptimal and actually broken if you're looking at it through a quantile lens. And so there's actually been multiple posts on X about this of people saying, well, the power law right now, the power law floor is at like 58,000, but if we go below, it'll just correct lower. Well, yes, technically when you fit regressions, they'll correct lower. And so it'll move lower. But it matters how stable your model is. And it matters when you start because the April start point has never corrected lower, only the Genesis start point. So hopefully that all makes sense. I kind of said the same thing 20 times to try and hopefully it hits home for people because it is important. And this is actually a pretty big discovery that the power law, it doesn't invalidate the power law. What it's saying is we've been using the wrong way of looking at the power law this entire time. We've been using Genesis as the assumed start point when it's actually one of the worst days you could use to start the analysis with.
Interesting. And it's also really interesting how the blue lines, or like the April 6 floor, is closer to the bottom here where it was higher, and also is under the bottoms here and closer to the bottoms also right here. So it's kind of like perfectly sitting there. But it seems like the April 6 is just like a weird starting point. It's like if you like it, because for me it's like there has to be like a thing
a significant event. I know.
Yeah, like,
right?
like it's
Well,
The
well, you
human
know
mind
what?
always wants to find something.
Okay, well, if your mind needs something, it's Satoshi's birthday. Yeah,
Honestly,
it is Satoshi's birthday.
shit.
So that doesn't, but there's no actual meaning behind that. It's just a coincidence. But if people need something to attach to, then it is Satoshi's birthday.
But how
Based,
funny is that? Like, how funny is that? Like, Satoshi's birthday, which might or might not be his actual birthday, but him giving that date as his birthday turns out to be the perfect starting point for the power law, which turns out to be the best model to predict the Bitcoin price. Like, that is more than funny to me.
yeah. So like when I didn't know Satoshi's birthday actually before I ran this, and I was actually searching for significant days around that point, and it basically said Satoshi's birthday. Now right away I'm like, well, Satoshi's birthday, there's no logical reason why that would create an event that would cause a starting point. It's just a kind of a simulation, coincidence, funny kind of thing, right? A synchronicity, whatever you want to call it. It's some sort of kind of fun coincidence. But the way I look at it is, like I said, is you don't need a specific event, because Bitcoin didn't become a Bitcoin overnight. It was a year-long process. And so I understand that people want to say, okay, the genesis, it's the significant event, the blockchain started, we need to start the analysis from there. But when you open your mind to, okay, no, actually Bitcoin from the white paper, because why is Genesis more important than the white paper? I mean, if you didn't have the white paper, then you would, like without the white paper was the first time that Bitcoin as a concept became a public, kind of in the public domain, right? The Genesis block was when it became a blockchain. But there's also what about when it was traded for US dollars? That's the first time Bitcoin actually became denominated in US dollars. It became something in the real world of value. So like there's a lot of firsts that happened. Everyone's very attached to Genesis with the power law, but there's no reason why it should start at that point. There's no actual law or reason that says it has to. And if you look at, like I said, if you look at the full window of time, which is a full year, April is roughly in the middle of that time. And so if you just take all the days and you basically say what's the most optimal model start point, that's kind of what it gives you. Now I'm still running analysis to kind of confirm and understand this more. This is ongoing, but this is kind of preliminarily what I'm finding. And if you just go back before we jump to the next chart, if you just go to the last chart quickly, people need to understand, or sorry, the no, actually two forward. Sorry, the other direction. Yeah. The one back. Yeah, that one. So, so people need to understand, I didn't fit these two lines based on the full data set, right? It's not like these were, so the blue line there, it caught the bottom for FTX without seeing that data, right? I removed the last 6 years of data, the last 5.5 years of data. I removed it from the data set. And I said, project out the lines based on the first 2/3 of the data. So if you just look at the FTX low, the April caught the bottom as good as anything. It was basically completely caught the bottom with the first quantile. If you were using Genesis, it would have gone significantly below your floor of that model. So in a practical sense, and it would have done it twice. We already went down to 60,000. The projections for this line, if it didn't correct lower, because the model knows it's wrong, so the math is always trying to correct itself. But it projected out 74. We've gone down to 60. So twice we've gone below this floor if you were using Genesis. So just empirically, you can see that people, okay, yes, April doesn't have a significant, you could say as a thing to do with Genesis. But if you want the best model, what I care about is trying to create a model that is actually the most useful. I don't care about philosophy as much as I care about practically, utilizing a model to understand Bitcoin. And so that's kind of where I'm coming from. But we can jump to the next one. We have just a few more to get through here that I think people will find interesting. So this is another huge correction, and actually very important discovery that I discovered related to the power law. So the power law, actually, the way the math is currently done, and this might go over people's heads, and I'll try to explain as best I can these 4 charts. So because you're logging time when you're doing a power law, with a power law, you basically compress time and you compress price, and then you have this straight line pattern when you do that. But the issue is when you compress time, you create something called a density bias. And what that means is all the recent data points are in a small sliver of time on the right side. Because when you compress time, right, if you look at time linearly, there's even spacing between every year. When you log it, you compress that time so that, visually speaking, it's becoming smaller and smaller, right? The right side of the chart is becoming more and more compressed. So all of those data points that are coming in are in a very small compressed window. So it creates something called a density bias. And what that does is it actually makes the power law fits when you're doing the quantile fits or the OLS fits. It makes them actually weight more recent data heavier. So if you look at the left side, so there's two columns here, there's 4 images. On the left side, you have unweighted. That's the one that everyone's using, right? So look at the bottom brown kind of bars there. See how if you look at the I guess it's 1 year, or no, those are 2-year buckets, or how is that done? No, what it's saying 2011. That looks there's something wrong there. But basically, it's because it's in it's because in log, that's why. So basically you can see that if you look at log time, it's heavier weighting the more recent periods of time. So the point is it's not evenly weighted, right? It's evenly weighted in linear, but it's not evenly weighted in log. So essentially what I did is I did a correction. In simple terms, what I did is there's a mathematical correction you can do where you make all the periods of time have equal weight. So when with the power law concept, and Giovanni's gone into this to a large extent, I'm sure on your show, you probably heard him talk about something called scale invariance. And scale invariance is this idea that there's a self-similar growth pattern that's happening at different scales over time. So when Bitcoin was a cent versus Bitcoin was 10 cents, $1, $10, $100, all the way up to the current day of 100,000, right? All those different scales, there's a similar pattern occurring. And so what this does is actually corrects for that and makes every single period of time have the same weighting when you're fitting the actual math behind it and fitting the patterns. So, I mean, this is probably going to go over most people's heads, but this, along with the start point, is another way of actually optimizing and fixing the power law in a lot of ways. Because to simply understand it is the power law has not been using the optimal start point, and it has also not been weighting the data equally. And if you look at that bottom right corner, you can see how all the buckets are equal, right? And so that's after the correction is done. All the data is evenly represented for the full history of Bitcoin. And that's important because if you're claiming that Bitcoin is a power law or follows a power law pattern, and if you're claiming that it's scale invariant, by definition, you have to evenly weight all the periods of time throughout Bitcoin's history because they all carry an equal amount of information that is valuable for the long-term pattern. And what this does is actually create a more stable model. And the regressions don't move around as much because it's not heavily weighting more recent data. When you heavily weight more recent data, then what happens is as new data comes in, the models are jumping all over the place. They're less stable. But anyways, we can, I don't know if you have anything you want to add, but otherwise we can jump to the next one.
I don't think I can add anything.
Yeah, this is a tough one to present, honestly, to explain this. It's a bit of an abstract one, and it's something that, yeah, in the most simple terms, there's a correction you can do with math when you're related to when you're compressing time and price. All it's doing is basically correcting and making it so that every period of time has the same influence on the fit, and throughout Bitcoin's whole history. It's not letting the more recent data have a more heavy weight or a more influence, right? More votes, right? It's saying like, okay, 10 people enter a room, every single person has even say in what happens. Not just, okay, these people came in the room most recently, they get 2 votes, everyone else gets 1 vote. Or this person came in last into the room, I'm going to give them 4 votes. It's actually as high as 9 times more weighting. So that's actually a good analogy. Imagine a room, 10 people come in the room. Doesn't matter how they enter the room, they all have an even say in what happens as far as a vote. The problem with the way the power law is currently is the most recent person that entered the room has more weighting than the person that came in before, that the person that came in before. And so the more recent data points influence the price more. So that's basically it. So when you correct for that, it actually makes a better, more stable model. So it's another way of optimizing the power law essentially. But we can,
why is that recency bias there? Like, why?
It's there because of the nature of the model, because you're logging time. So the power law for Bitcoin is actually a very unique power law. It's actually not a very common power law because you have two inputs. You have price and you have time. And time is also how you're measuring things, right? So because of that, when you compress time, what it does, if you just imagine like one of the charts we were looking at, when you compress time, what you do is visually speak, because we look at things linearly. Like when you look at something, you see these even spacing between time, right? Every year, if on a calendar or on a chart, you see an even amount of space. When you log time, you'll see that the years become more and more compressed on the right side. And when you do that, all the data points become more and more compressed. And so that creates what's called a density bias. So because you have all these data points in a very small visually on the chart, the regression will higher weight that weighting of those data points because they're all compressed together. Whereas on the left side, they're spread out. And so this is just something that's not normally an issue with power laws. This is an adjustment that very rarely has to happen. And it's only because, and this is why like Giovanni and these other people that are very smart have not done this, is because it's very uncommon to do power laws that are time series. Time series is when you're using time as one of the two inputs. It's a very rare power law. If you look through all the different sciences and you look through all the different types of power laws that exist, I mean, there's power laws that in hundreds of different fields, right? Giovanni can speak for hours about that. There's power laws everywhere. Everything's a power law, right? So all these power laws, but what is unique is that the input is time. And it creates this specific compression and this density bias that doesn't exist in other types of power laws. So that's why this correction was never done. It was overlooked, is because 99% of the time you don't have to do it. It's only very, very rare cases that you have to do this compression or this adjustment. And it's when you have a time series, and it just speaks to how unique Bitcoin, the Bitcoin power law is. It's a specific type of a power law. It's like a subcategory of a subcategory. It's a very niche type of a power law where you have time as an input and you're comparing two variables, and then you're also measuring that on the x-axis with time. So that's hopefully that makes sense for people. But yeah, we can jump to the last two here. Okay, so this I think people also find very interesting. So what this is basically looking at the fair value. So one of the ways you can assess fair value for Bitcoin from a statistical standpoint is you use the 50th quantile. And what that is it's also known as the median regression. And so by definition, 50% of the time we're above that point, 50% of the time we're below that point. So I have three columns here. I have today's value, which is actually based on just a few days ago when I ran this. And then it shows 5 years into the future, and it shows 10 years into the future. So this is looking at the middle of the data set, right? Before we were looking at the bottom, we were looking at the floor, but this is actually looking at the middle point, right? The fair value. And so there's different types of regressions you can do here. But what I did is I used the time, this is actually time unequalized, sorry. So this one is based on Genesis, and this is based on not equalizing the time. So if you don't do the adjustment, so this is just the one everyone's using today, right? So this is just the power law that pretty much everyone uses. It's Genesis based. It doesn't adjust so that everything has even weighting, and it's based on the middle of the data set, the 50th quantile. So what I did, if you look at the very top one where you see it says OLS regression, where it says mean, so that's saying 125,000 is the fair value today. Now that's looking at it through the lens of a mean fit. So that's an average, right? There's issues with using an average. Some people use it, but I would actually advise not to use it, because an average, what happens is you have the extreme peaks of the cycle, and that pulls up the average, right? That pulls up the fair value because you have these extreme events at the peaks, that basically skew your fair value. So it kind of inflates the fair value in a simple way because of those extreme outlier events, right? So usually when you're doing data analysis, you don't want to let a few outliers influence your average, right? It's kind of like if you go in a room and you have 3 people that are 7 feet tall and everyone else is 6 feet tall, right? And you say, well, the average, or say you have, what's a good way of looking at it? So say you have 10 people in a room and 9 of them are between 5'10" and 6'3", and then one person is 8 feet, right? They're going to bring up the average height of everyone in that room. And you can't say, well, the average height in that room is 6'8". Well, no, it's actually between 5'10" and 6'3" or whatever, but one person entered the room and they're 8 feet tall. So that's what the OLS regression does, is it basically, it inflates the fair value because the extreme peaks pull up the price. So I like to use one below it. What's called the median, right? The quantile 50th quantile. So that's at 119 today. So you can see it's $6,000 lower as the fair value, and that's based again on Genesis and not normalizing the buckets or the weighting. So what I did here below is I ran all sorts of decay functions, and the reason why I did this was I wanted to show that the fair value that the reason why this is practical is there's all sorts of power law charts that you'll find on X. There's all sorts of power law charts you'll find on different websites. Well, just so everyone understands, the fair value they use, right? The middle point where they run that regression, it's done using one of those top 2, which doesn't account for decay. So both the numbers are high. So I hate to break it to everyone. Again, I told you I wouldn't bring hopium. I would just bring the math. But I'm going to tell you what the actual statistical fair value is for Bitcoin, not the inflated versions. So because a lot of people say, well, you'll see people even posting on X, oh, Bitcoin fair value is at 125. We're trading at 65,000. We're way below fair value. Okay, we are below fair value, but is the fair value really at 125,000 today, or is it even at 119? I would argue it's actually much lower than that. And so if you see how all those regressions I ran, so these are all different types of models. We don't need to get into this, but basically I ran, what is there, like 8 of them, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, or there's like 10 or 11 of them. So I ran 10 different completely independent fits and models, and see how they all basically got the same price. So they all are saying the fair value is around 110, 111,000. And see how the top 2 that are straight lines are higher. And all these bottom ones that allow for what's called decay, meaning there is some amount of, at the 50th quantile, there's some amount of diminishing returns that's occurring, a small amount that's already occurring at that middle point of the data set. It doesn't happen at the bottom. So the very bottom of the single, if we were to do this, I actually did this with the first quantile, and these numbers would all be the exact same. There'd be no difference. So this basically proves or shows that the fair value that everyone's using is wrong. Because if you allow for decay, if you'd use any of those bottom 10, you get a similar number. And then the only 2 outliers are the ones at the top where you use straight lines. So we can jump to the next one, which is the last one, because this is the one that I think people should be using. So what this is it's the optimized start date, April 6th. I did the time normalization, so equalization, where all the periods of Bitcoin's history get the same weighting. And then instead of using those top 2, because again, those ones are inflated because they're not accounting for the decay that happens. Look at how all those bottom 10 are all saying around 101,000. So if you look at today's value, the fair value for Bitcoin, based on basically math and statistics, the correct answer as far as the fair value is not 125,000 like a lot of people post online. It's actually 101. And I know that doesn't sound as bullish and as hopium as people want to hear, but if you want to set your expectations realistically, the actual answer is actually 101,000. Again, people can say, well, the fair value I think is $1 million. Well, you can have that opinion, but based on the math and statistics, there is a number you can get to based on the data set. It doesn't mean that Bitcoin's not worth more than that. It's just saying that based on the math, that's what it's saying today based on all the data points we've had to date. So it's not saying Bitcoin's not worth more. Clearly it's worth more, but it's just, if you want to have a fair value through math, that is the number. And then you can see what it would be worth in 5 years and 10 years. And you can see the confluence. These are all different models saying the exact same thing, right? So I'm looking at this through quadratic fits, through fractal polynomials. Like you can fit all sorts of different types of patterns, right? And they all converge around 100 and 101,000. The only ones that don't are unfortunately the ones that everyone is using, which are the ones you shouldn't be using, which inflates the fair value. But yeah, we can basically wrap it up here, but I'll just, for people, they can have, it does make a difference. People will say, well, 101,000 fair value, that's not that much different than 125, but look at the 5-year projections and 10-year projections, right? So the fair value in 5 years, if you're using, the standard power law metrics, you'd say, well, the fair value is 542,000 in 5 years. Well, actually, it's closer to 375,000 in 5 years as the fair value. Now, it doesn't mean Bitcoin can't be above that. It doesn't mean it can't be below that. That's just the middle of the data set. It can be below or above or whatever. It's the same, and same with the 10-year projections. I like to stay within 5 years. I think going beyond 5 years projecting it becomes very tricky. We have about 16 years of data, and so projecting out 5 years is reasonable. But projecting out 10 years, it does get pretty opaque and pretty hard to project out that far. But I just put it there for fun so people can see. So based on everything here, it's saying the fair value for Bitcoin in 10 years will be about $1 million, right? Pretty much. And the fair value in 5 years will be about 375,000. Now, it's a lot less, unfortunately, than the top two, which say 1.6 million and 520,000 or so, right? I don't know if you have any thoughts on this. Sorry to rain on everyone's parade. It's obviously still very bullish long term.
I just wanted to say, like, I think it's amazing. Like if we hit those prices, like Bitcoin is doing phenomenal. Like if you think about fair value being now 101, that's about 50% higher than we are right now, like 40-50%, whatever the exact number is. If we're going then in like 5 years to, let's say, 400K, 300K, 350K, something like that, that's amazing. And hitting $1 million in 10 years, that would be what, like a 15x roughly from here, something like that. I don't know if my math is correct now, but like it's like a lot more than 10x, because we are right now, as of this recording, under 70K, and so that's amazing. Like if you want more, go in the casino, like gamble.
I share the exact mindset with that, or the exact sentiment. I think people need to understand, like, these are so this is removing every ounce of hopium you can remove. This is only looking at the data we have to date. This is looking at the math. There's no hopium here. There's nothing additional, right? So that's what the math says, right? That's the fair value, roughly, say 400,000 in 5 years, 375, 400 in 5 years, and $1 million in 10 years. Now, that's the fair value. So at any point in time, we can be significantly above that or significantly below that. So it doesn't mean we can't hit $1 million before 10 years. We absolutely can hit $1 million before 10 years. At one of the peaks of one of the cycles, we can be at the top quantiles. We can be at the 90th quantile, 95. And so we can reach $1 million before 10 years. But this is saying fair value in 10 years, just like today's fair value is 101. Basically, the fair value will 10x over the next 10 years, right? And so that's super bullish. You don't need hopium. I mean, I get it. People want to be at $1 million in a couple of years, but that's not what the math shows. Now, anything's possible. It could happen, but I think it's important to set reasonable expectations. And like I said, to wrap it up, what I just presented there, after going through everything, is removing every ounce of hopium you could remove. Like the start date actually makes the targets slightly lower. Using the even weighting doesn't affect it as much, but it does still make it lower. As you can see, when we were using the uneven weighting and we were using Genesis as the start date, it said the fair value today was like 110 or 111. So yeah, in my opinion, when you kind of use the most optimized model, it's saying around 101,000. So we're still, like you said, well undervalued relative to what the data says, and just in a few short years, I mean, the fair value goes up quite a bit. So yeah, hopefully that helps people that have like long-term conviction understand that um, it's kind of like the way, I mean, you just, the problem is when you spend so much time on social media, every couple of days someone's coming out calling for 500,000, calling for $1 million, right? Because that gets so much clicks. Like if you create a model that says like the stock to flow, if you create a model that says we're going to go to $1 million in a couple of years, it's going to do a lot better than someone that's saying it's going to take us 10 years to get there as the fair value, right? Um, but you got to understand, Bitcoin at $1 million, that's a $21 trillion market cap, right? And it's not going to stop there, right? And like I said, we could get there before 10 years. We absolutely could. That's just the fair value. So as gold goes up in its market cap, Bitcoin's target also goes up, right? It's a whole other topic, but yeah, as gold grows, there's more potential for Bitcoin as well. I mean, it's not just gold; it's global wealth. As global wealth inflates because of money printing from all the countries, there's more. Bitcoin has a higher ceiling, and it will continue to go. It's not going to stop at 1 million. But, anyways, that's basically all I wanted to cover today. Hopefully, a lot of that made sense and grounds people a little bit in the data. And it's a lot to digest. So, I mean, it ended up being pretty long podcast. Sorry, I rambled quite a bit, but
I love it. I love it.
man.
I've one more question on. I'm also making it a lot longer because I have a lot of question. But like, how much inflation is in there? Because this is always what people say with the power law. Like, how much is inflation accounted for in those numbers? Because we also know like money printing tends to accelerate. If you think about how much money we printed the last 10 years, it's a lot more than the previous 10 years before that, and so on. And so like the depth and all of those is like kind of accelerating. How much is that kind of factored in or like based into the models?
So that's actually a really important and interesting question. So what you can do is you could inflation adjust the model. So there's actually multiple ways you could do it. You could actually use the M2 money supply, right? Instead of US dollars, you could actually create a power law that's relating to M2. So that would basically factor in that money printing, right? If the money printing changes. So with Bitcoin versus US dollars, what's factored in is the historical pattern. So all the inflation that's existed through Bitcoin's entire history is factored into the model, right? But what's not factored in is rate of change. So if because the inflation fluctuates year to year, right? But if you look at inflation over longer time frames, I know we had a lot of printing during COVID and stuff, right? We had a huge increase in M2, but on higher time frames, inflation is roughly 10, 11% or whatever it is around there, right? Which historically is why stock market and gold tend to go up on average like 7 to 12%, is because that's how much money printing there is, right? It's kind of like soaking up that money printing. So a lot of the hard assets, gold, you could say S&P stocks, they tend to go up kind of to balance out that inflation, right? But to answer your question, it doesn't account for future inflation as far as extreme changes. What it accounts for, what the current power law models that model price versus time account for, is the inflation we've seen and the patterns we've seen with inflation to date. So if we got 5 times the inflation over the next 16 years, it would change the model. It would absolutely change the model. And probably the targets would be higher. I mean, so if you think there's going to be more inflation, like dramatically more, I'm not talking about a little bit more, like a few percent more is not going to make much different. But if the inflation doubles, like if the US all of a sudden the inflation is twice as much or whatever, like the M2, right, the money supply doubles, as far as how much it's increasing, then yeah, those targets will probably would be a little bit higher. So basically, all the targets I showed there are based on comparable money printing that we've seen over the last 16 years. And if you think it's going to be dramatically higher, right? The whole point of modeling Bitcoin versus US dollars is you think the US dollar is going to be stable for at least the next 5-10 years. But if it breaks its stability, then that's where we'll see probably higher targets, right? So that's when you get slightly more bullish scenarios. But if we see the same amount of inflation, those are kind of the targets. If we see dramatically less inflation, I don't know how that's possible. But if we somehow see dramatically less inflation, then those targets are probably too high. But yeah, we'll see.
And I think in the end of the day, it doesn't really matter, because if Bitcoin price goes up and it goes up twice as much because of money printing, you don't really have anything from that, because your purchasing power is the same.
Exactly. What matters is purchasing power for people. What practically matters is not how many numbers they have on a screen. What matters is what they can actually buy in their life to improve the quality of their life, right? So, houses today are whatever, like way, way, way more expensive than they were 50 years ago, right? It's all relative, right? It's all people's salaries, everything's relative, right? It all goes up with inflation. And so in relative terms, what matters, like you said, is purchasing power. And, people don't care necessarily about, okay, Bitcoin's going to be worth this number. What they care about is, okay, when if I do want to improve my life in some meaningful way, and I want to sell some amount of Bitcoin in 10, 20 years or whatever every person decides, what can I buy with that, right? If inflation goes up, 10 times, right? If there's 10 times more money in the world and Bitcoin only goes up 5 times, well, even if it's gone up 5 times, it didn't keep up with inflation. So why does it matter, right? So just as an extreme analogy, obviously I don't think that's going to happen. I think it would be more like 50 times if it would, whatever the money supply increases and inflation increases, Bitcoin's going to do a significant multiple of that, in my opinion. So yeah, purchasing power is what matters. These numbers just help us to kind of look at things in relative terms based on today. But obviously over time, $1 million today is not necessarily worth $1 million the same in 10 years, right? But it's going to be more than what it's worth today is the point. So
I love that. We went way over time. I even moved in the background. If you guys saw me clicking on my computer and appointment quickly around, because I found it too interesting to interrupt the recording. I was like, I'll just keep on going because this is more important in my view. And so thank you so much already for doing that and giving us your two. We also started before the recording already half an hour. It's I think we're already in the call for 3 hours now. The end of the recording will be more 2.5 hours maybe. I have a few more questions for you, two more. One question that I asked each and every one of my new guests on the podcast is the question, what can we learn from you besides Bitcoin? And I also tell you the intention with the question. My intention with that is I think Bitcoin at some point will be very boring. And so I'm curious what other interesting things, interesting topics, or whatever you want to kind of bring up, do Bitcoiners also have in their lives besides Bitcoin?
Well, thank you for the opportunity to talk about something beyond Bitcoin. I appreciate that. I have many passions beyond Bitcoin, and honestly, Bitcoin is not even my main passion. It is definitely a significant passion of mine, but my actual main passion is actually more related to health and wellness. And I'm a bit of an obsessive biohacker myself, and I've been since I was 20. So for quite a number of years, I've been very interested in quality of life. I played, basketball in university. I had a basketball scholarship in university, and so I was always very obsessed with exercise, weightlifting, just training in general. Like at a high level, I played a lot of sports at a high level. And so, for me, it's how good can we feel in our bodies? That's a passion of mine. That's mental and physical. So what we do as far as what we choose to eat, the way we live our lives, and it's multifaceted, of course, but everything we do as an input into our bodies, has a factor on how we feel, right? How we feel day to day, the quality of our life, how we feel when we move around, our joints, everything about that. Like I could go on and on for another 3 hours on this topic, but I I love to weightlift. I weightlift basically every day, 6 days a week, roughly, I would say. And I'm actually doing something unique right now, which is uh, at an older age, I'm not trying to, I'm going to regain the same athleticism I had in my 20s. And I'm doing this through optimizing basically everything. So this is actually a personal passion project of mine. I'm trying to do something that many people would say is impossible. So when I was in my early 20s, I had over a 40-inch vertical. I'm 6'6", and I could touch almost 12 feet. The highest I got was like 11.9. For people that don't know, that's like well over the rim, right? So hoop is at 10 feet, and I was able to actually hang on the hoop. I was able to hang on the rim with my elbow when I played basketball in university. So I was had quite an athletic gift and was blessed with being able to jump extremely high. But I took that for granted at the time, and I didn't actually realize how rare that was to have that kind of a vertical, and that feeling of basically just flying in the air when you jump and play basketball. And so at a much older age, I don't want to say exactly, but basically at a much older age, I am training in as intense as I ever have, and I'm making a lot of progress to actually regaining the same. My goal is to actually beat what I was able to do when I was 20, which was a 41-inch vertical, and so I'm looking to beat that, and that kind of creates this, like, when I think about, okay, when I go out and I'm eating food or whatever, for me, the feeling of feeling good in your body outweighs any pleasure from food or any pleasure. So it's not to say I don't occasionally have a treat. I do, but I'm very disciplined. And this personal kind of passion project of regaining my athleticism I had in my 20s is making it so that every decision I make, I think about that as my goal. So I actually don't eat. I eat an extremely clean diet, and just everything I do as far as what I take supplements and all these different things I do as far as my training. I train about 2 hours a day at the gym, and so yeah, it's a long conversation, but that is my passion. Honestly, my true passion beyond Bitcoin is I had a wellness center, like I said, in Canada for a decade. I had a wellness center, and so like I've always been very, very much interested in the wellness space, life extension, quality of life extension, doing things that people perceive as not possible at certain ages, right? Staying mobile, staying strong and athletic, and there's something about sprinting and jumping that makes you feel young. And when you can do that at a later age, like you feel younger. And so I think there's a lot of stereotypes around aging, and I personally am looking to break a lot of those stereotypes. And there's definitely outliers, and so I look to those people, and yeah, I just love this topic. I could talk forever about it.
I love it so much, and like lifting weight is something I love, but I always get distracted. And it's something that when I do it, I'm feeling at least 5x, maybe even like 6, 7, 10x better than when I not do that. And it always trips me up if I travel, if I have other things in life. And right now is a period of my life where I'm finally back at it, and I just like, it's so much better. Like it takes me some time, like you have to go out and you have to actually do it, and it just takes up time, but it's such a rewarding thing to do, and you feel the whole day way better. And what I've also noticed, things face you less. If you start your day working out, especially lifting heavy weights, if no matter what comes your way, you're like, I'm good. Like I'm fine. Like it's almost like there's this meme of boys are going to the gym for like mental therapy, but I think there is some truth to that. Like I'm doing mentally so much better if I was at the gym that day.
Like, yeah, I mean, 1,000%. Like, I think it's an essential. I think it's essential. Like, I don't even think it's some form of movement is absolutely essential. It doesn't have to be weightlifting. You can go out and do sprints. You can do whatever you enjoy doing. I think it's important to enjoy it. like I enjoy it to the point where it's one of the things I look forward to the most in my day. So like if I'm sitting at the computer a lot of hours, I don't think like, oh shoot, I got to go to the gym later. I think like I am so excited and can't wait to go to the gym, because to me it's the perfect way to break up all the sitting I do throughout the day. And I go into the gym for like an hour and a half, 2 hours, basically 6 days a week. I mean, that that to me is like one of the highlights of my day, because I know how good I feel from doing that. And you really, it's a different type of thing. You can sit on the computer and you can use your brain and you feel like you're doing work, but there's something about being human that the body says, no, you're not doing work until you're moving heavy things. Like, we evolve in nature. We like to think we're so different than everything else. But I mean, movement is essential. It's essential part of being human. And our body and our biology is designed to respond to that and give us a lot of feel good chemistry, right? We get a lot of feel good, our hormones, our mood, our stabilizes. Like there's so many ways that our biology works better, our mental health is better, like you said, and just relieving stress. So to me, I mean, you're not performing your best in any aspect of life if you don't have some sort of consistent routine of exercise. You're leaving it on the table. I mean, everyone's busy, but if you're not exercising, you're not the best at whatever you're doing in life. It's just that important. I mean, and nutrition's a whole nother thing. I mean, I think that's equally as important as exercise. That affects you dramatically in many ways, but exercise to me is like one of the best outlets, and it's one of the things that I love in life like the most. And it really does, like you said, when you're exercising consistently, like you just feel so much better and you're so much more productive. And whatever hours you spend in the gym, you get back like 5 times in productivity and in getting in less drama, because you're more stable emotionally. Like things don't phase you, like you said. So yeah, it's so important.
And you might actually get them back in the end of your life with actually more life expectancy. So I think like working out is, we talked about very in the beginning, the only thing that is more scarce than Bitcoin is time. And it's kind of like a perfect kind of loop to the end now, where if you work out and you do those things, this might be the only activity you can do besides eating healthy food and like caring for yourself in general. I mean, there's a whole another 5-hour episode we could do on this. But all those things are the only things that you can do to actually get more time back in your life. And yeah, like it's a lot easier to make 1 Bitcoin than to make 10 years of your life like back. It's a lot easier to create Bitcoin than time.
Exactly. And there's a quick analogy that I can use to express this to people. I think that people find interesting. Like, so if you're, okay, how can I say this? So anyone that's in their 90s, that's a billionaire, do you think they would give all their money to be 40 again or 20 again? Of course they would, right? So that's how important, that's how valuable time is. It's worth more than all the money in the world. I mean, there's a reason why all these extremely wealthy people spend their money trying to regain their youth, their health, extend their life, because that's really what it's not just extension, it's quality, it's meaningful memories, it's meaningful connections with people you love. But more time and quality of life. I mean, that's invaluable. I mean, there's just so I mean, it goes along hand in hand with Bitcoin in many ways. It really does. Like, I mean, Bitcoin is a tool to buy more time in your life, and then what you do with that time is really up to you. And that time, I mean, just feeling better during whatever you choose to do, like feeling better physically and mentally, that's what life's about. And then you can really, because when you're in a good physical and mental space, you're better, you're kinder to the people around you. You're a better positive influence on your community. You're a net positive to everyone around you. It's not just a selfish thing. Like when you feel physically shitty, you're an asshole to everyone around you. You're more likely to be an asshole, like you are. And that affects other people. So it's one of the best ways to upgrade humanity is literally for people to just I mean, just take care of themselves. It's extremely challenging. I get it. For a vast majority of people, they're extremely busy. They have a lot of, things they need to do in their work and their family, and I get it. But there's also a lot of wasted time that people spend, vegging out or whatever. And I understand people do that because they're stressed, and it's kind of a self-fulfilling cycle. Once you start exercising and eating well, that helps deal with a lot of that stress, and then you're less likely to just veg out and waste time. I actually find when I'm eating the best and I'm exercising the most consistently, I have the strongest desire, or I have the strongest ability to not waste time doing kind of things that are just junk food consumption of whatever input, and I actually crave more meaningful uses of my time. And a lot of that comes down to your biology, your brain chemistry, how you feel. So it's all connected, man. It really is. Like, yeah, again, very passionate about this subject. If Bitcoin disappeared tomorrow, I would probably spend all my time talking about these sorts of things instead. Like, I don't know, like, apply statistics to health or something. It's to me, it's a huge passion for sure.
I would love to see that. If you ever do that, reach out to me. I would love to dive into that. I think Bitcoiners. I think also most of, like, for the people that made it so far in the podcast, like 2.5 hours in, leave us a comment if you would like to see Plan C breaking down all the data sheets on healthy food, on gym, and all those things, because I personally think most Bitcoiners would absolutely love to see that. And I want to just spend one more moment on this positive flywheel effect of going to the gym, eating clean, and all those things. If you do one thing right in the morning, I love working out right in the morning. It sets up your day in the right way. And it sounds so weird. Like you heard that like probably like 1,000 times in like weird motivational videos, but it really changes something in you. When I work out, I want to eat really nice food. I don't want to eat junk food. If I don't work out and don't work hard, I'm way more like, let's eat that. Like, let's get a cake there. Like, I'm way more inclined to eat shitty food. I've never looked into the research or like why this is. It's just like my personal observation. If I just set up the right mood and go to the gym in the morning, the whole day is way better and way more focused, and like I'm like, I have something nice. It's very hard for me to explain, but it makes a whole thing. And then this is the positive flywheel. And there's also negative flywheel of like, if you don't go in the morning, and then you're like more likely to eat shitty stuff, and then you feel also worse, and then you have bad thoughts in your mind. It's almost a downward spiral from there. And if you go to the gym and do all those things, it's like an upward spiral, like a positive flywheel, if you so will. We could probably model some framework around that and give it some data. But yeah, like I love that you're also passionate about that stuff.
Oh man, there's a lot to what you said there. Going to the gym, testosterone for men, it affects your dopamine levels, your motivation. When you lift heavy weights and when you exercise, you're more likely to sleep better. That creates a positive feedback loop. When you don't sleep well, your body craves sugar a lot more. So sleep, like, I don't know if you've ever tried this experiment. Well, don't do it on purpose, but if you stay up really late, try to quantify how much you crave sugar the next day versus when you get a good sleep. You can actually like quantify this, and it's basically, there's a connection here, because when the brain is tired, it craves simple carbohydrates and simple sugars, basically. And so when you don't sleep properly, it's extremely hard to not eat sugary food and junk food. So again, if you're exercising throughout the day, you're going to get deeper sleep, easier to fall asleep at night. We're meant to do physical work. I mean, we've evolved in doing physical work in nature. And that affects, for anyone that's having a hard time sleeping, go out and do 8 hours of physical labor. You'll be exhausted. You'll fall asleep. I mean, it's like we're our bodies, when we just sit on the computer all day, we yeah, our brains are going all the time, but our physical bodies aren't. And so we lie in bed and we have all these thoughts. But when you exercise, you sleep better, you crave less sugar the next day. There's other feedback loops. There's multiple feedback loops, right? With hormones, with blood sugar levels, stabilizing blood sugar. And like you said, when you exercise, I crave real food. I'm the same. When I'm exercising, I just want like high quality, food, high quality protein, and my body craves like real, like actual food, not this synthetic crap that most of society is fed constantly, unfortunately. But yeah, real food, you just crave it, and you feel so good from it. And so yeah, it's like it's kind of crazy when I think about periods of my life where I stopped exercising, and then the dramatic difference. I don't know why the brain forgets, but it's almost like you feel like you're a different person. It's like you can't remember how good you felt because we get so used to our baseline. So like once you've gone a few months of doing anything, we're kind of like in this perpetual motion thing where people, their baseline, they kind of forget that like a baseline is only your baseline right now, but we've had different baselines at different points in our life. And it's like, yeah, how good you feel is all relative, and it's most likely your baseline and how you feel is only related to the last whatever 6 months of what you've been doing. So we kind of forget how good we can feel when we're actually exercising, and when you kind of get addicted to that feeling, it's so easy to not do the things that can entice us, right? Once you're going to be addicted to something. The way I look at life is like addictions is kind of like part of being human, so you might as well get addicted to things that are beneficial for you as much as you can. Like I mean, I'm happy to say I'm addicted to exercise, I'm addicted to eating well, addicted to certain things because um you're going to be addicted to something, so might as well find healthy addictions, I guess.
And I don't know, like I don't know if it's an addiction. Like I wouldn't frame it as that. Like if, like I could also say I'm addicted to water because if I don't drink it, I'll probably die. It's like I'm very addicted to water, or I'm very addicted to air. Very addicted to those things because if I don't get them, I have very hard problems. I probably die quite soon with air, very soon with water, also very soon with food. Quite soon also, and that's the thing, like if you don't exercise, it's like a slow death and it's a worse life.
It's a good way to say it. I mean, it is an essential input, but I guess when I say addicted, I'm talking more about that feeling. Like you can create that feeling artificially, right? There's a feeling of feeling good, and that feeling you can induce it with artificial means, right? If you're sitting down vegging on some TV show, you might get a temporary boost of certain neurochemistry that makes you feel good in that moment to a point. It's like a self-soothing thing, but long term, it's not going to give you that self-worth that makes you feel good throughout your entire day, right? It's the same with exercise. Like exercise induces a feeling of feeling good as far as like self-worth thing. When you're consistently exercising, you have more self-worth, you just feel better overall, and it's consistent throughout your day. It's not just like this, okay, 30 minutes or this five minutes because I ate a bunch of junk food. Okay, you get this brain chemistry very short, the spike, but then there's this big crash. So what I'm talking about is being addicted to sustainable, healthy feelings that are self-generated through hard work and through consistent effort in doing things right. That is it's a real actual created feeling of feeling good. There's a lot of artificial ways of creating that that are not good for us. Like that's kind of the point is you can inject drugs, you can do all sorts of things that make you feel great, but it's obviously not a sustainable path. So there's not that many sustainable things you can actually do in life that consistently make you feel good. And exercise, eating well, and having good relationships around you and experiences in life, that's basically the only sustainable things you can do to feel good. I mean, there's not like this long list of things you can do. I mean, a lot of there's a million artificial things you can do. You can eat junk food, you can, watch whatever stuff, you can waste your time, you can get a quick fix from gambling, or a quick hit from whatever, drinking a bunch. Like there's all sorts of quick fixes, quick hits of dopamine and serotonin and feeling good in the moment, but it's not sustainable long-term feeling good, right? And yeah, that's really what I'm addicted to is that feeling. I've had it at periods of my life in a quite sustained way, and I'm just my goal now is to basically find a way of, or I am creating a way of kind of feeling that as much as high as high. There's still life. You're still going to have good and bad days. You're still going to have unfortunate things that happen in your life. Everyone's going to have their own different things they deal with that are very traumatic and very difficult. So it's not like life's all going to be roses just because you go to the gym and eat food, but it sets you up. Again, it goes back to probability. It sets you up for the highest probable being able to deal with those tough events in life, being able to sustain the highest probability of having a good day. Doesn't mean every day is going to be good, but it gives you that fighting chance to feel good as best as you can in your unique biology. Sorry, man, I'm rambling more than Bitcoin here.
I have one more thing I want to touch on because I think it's important. I have a weird observation, and I'm curious if you shared that observation or if you have any notes on that. I've seen the calmest and nicest persons are the ones that taking care of their body, and the ones that are weirdly aggressive or like passive aggressive. You know what I mean? They usually don't go to the gym. They usually don't eat well, and they usually like I found that weird connection between people that look really ripped and are more like just like you see them and you're like they're taking care of their body. They are less aggressive, which is an interesting thing. I don't know if it's just my thing or if you also have seen that.
Oh, I've experienced it firsthand. I mean, I've been around. Like I've spent a lot of my life in gyms and a lot of my life in sports, and I can contrast that to a lot of people in my life that I know that don't do sports and don't exercise and don't eat well, and there's a clear connection there. Absolutely. I mean, there's outliers, of course, but in general, there is a higher probability and a higher average, you could say, where people that are generally nicer are probably have that some sort of an outlet where they're doing exercise and they're taking care of themselves. And the only exception I would say to that is if someone's like taking extremely high amounts of steroids. Okay, yeah, they're probably like, I mean, in any normal amount, right? If someone's taking testosterone replacement or whatever they're doing, right? That's different. But the people that are obviously like massively abusing steroids, even if they're going to the gym a lot, they might still, not be the nicest people necessarily. There's a stereotype there. It doesn't mean it's always true. But in general, that's the outlier. In general, the vast majority of people that go into the gym, they're not taking, drugs and they're just lifting weights, whatever. On average, in general, absolutely, I think it impacts the likelihood those people are going to be easier to interact with. They're not going to take out you're not going to be their outlet, right? For their energy. Their outlet is through exercise. And so, yeah, I think it's kind of crazy, man. It's kind of crazy. Like again, the last thing I'll say on this is like, we're literally designed to move and exercise as humans. Like it's super unnatural. It's beyond unnatural to sit at a desk all day or think about it. Most people, they wake up, they sit in a car, go to work, sit in an office, get back in the car, go home, then they sit in front of their TV. Like that's a lot of just not moving, right? It's so unnatural. Go find any animal in nature that just sits in one spot and doesn't move. Like for the whole day, right? And just stares at like it's the equivalent of seeing some animal in nature just sitting in front of a tree and just staring at it for 12 hours straight. Like it's just not a thing. So anyways, it's just what we think is natural is so unnatural. Like what we do with our bodies is super unnatural. And I mean, I've worked in a past life. I've done many things where I did a lot of physical labor, working on organic farms and things like this. So I've experienced like, what people used to do, say 100 years ago, when you used to have to grow your own food and work, farming and things like this. I've experienced like physical labor. And it's a different beast. Like most people 100 years ago, they would spend their whole day doing some sort of mild physical labor, like just perpetually. I mean, you're moving, you're lifting, you're doing stuff. So it's a very modern thing to not have to do physical labor at a low level almost all the time.
It's crazy, and we could literally talk forever on this topic. I love it, but I want to be respectful also of your time. I do have one more question actually, where it's our end routine where the previous guest is asking a question for the next guest without knowing who the next guest actually is, and he asked a very interesting one. And feel free to say say no to that question. But he asked the question: what is the most embarrassing moment in your life that you are willing to share?
Oh wow, that's a tough one to answer. I mean, I wouldn't necessarily say I have a lot of extremely embarrassing moments, but I'd have to like off the cuff. It's honestly a really hard question to answer. Uh Really embarrassing moment. Ooh. Um. Damn. Sorry, man. I'm drawing a bit of a blank. Let me think.
I have
I mean, it
one.
would probably be something in my. Oh, go ahead, sir.
Oh no, go ahead. I just wanted to buy you some time.
Yeah, well, I would say it would probably be something related to like when I was younger. Like I'm trying to think of something specific. I mean, so when I was like grade 3, 4, 5, I moved between schools. So like I basically yeah, I moved like grade 3, grade 4, grade 5. I was in 3 different schools. And a couple times I started the school year a couple weeks into school. I guess my parents were just trying to figure out what school they wanted to put me in or whatever. I was kind of moving around. And so I think some of the embarrassing moments were joining joining classes late and kind of being behind the class and not knowing what's going on and maybe asking some dumb questions or something, that sort of stuff. I uh also like reading in front of the class, like really struggle with that, like because I actually have something called phonological dyslexia. So numbers, like math and numbers has always been very easy for me, but as much as I excel and I've always excelled at like basically math and these sorts of things, I was equally bad at spelling and reading and things like this. So it was very challenging for me with phonological dyslexia to read in front of the class because I naturally couldn't sound out vowels. Phonological dyslexia means you people think of dyslexia like you mix around letters, but that's not it. It's phonological dyslexia. Specifically, your brain cannot sound out vowels properly. So I can't, could people say like, oh, and just read this word, just like sound it out. Well, I just can't. So I literally had to memorize it. Like, so I can read fine, but it's from memorization over the course of a lot of years. And so my brain's adapted to be able to function. Like I still have to spell check everything extremely because I like naturally I have a very hard time with spelling. So probably my most embarrassing moments in my entire life that I can think of. I mean, there's probably some I'm missing that I just can't think of, but the ones that I remember being the most stressed about were reading in front of the class, having phonological dyslexia, knowing that basically I would struggle like crazy to be able to read in front of the class. And I only had to do it a few times, but just the amount of times I remember sitting in my chair being like, please don't call me, please don't call me. I didn't know I actually had phonological dyslexia until I was in grade 12. So it didn't get diagnosed until I was in grade 12. I had to go get this assessment done. And it was quite interesting. They looked through all these things, and so the way they actually assess it is they have to look at your baseline. They have to say what's your IQ. So my IQ was actually above average, but it's actually through statistics. They look at standard deviations. So my spelling and reading was so far below my IQ. It was actually more than 2 standard deviations below where it should have been. That's how they diagnose you. So I was in like the bottom percentile or the bottom quantile, you could say, with my spelling and reading. But with math and something called matrix reasoning, I was in like the top percentile. So it's like my brain compensated. It went one direction and the other. It's like, letters you can't do, but math you can do. It's very interesting. So but yeah, I don't know if you can relate, but that was like such a fear when I was in school, was like, because I was also very shy. I was also very introverted. I am very introverted. As much as I talk on podcasts and as much as I talk, one-on-one with someone, I am a relatively shy person. And in high school, I was extremely introverted. I had kind of like social anxiety. And that was my outlet with sports. So I was very active with sports because that's where I felt comfortable. And so, but yeah, social anxiety combined with phonological dyslexia, not a good recipe for reading in front of the class.
I think most Bitcoiners are introverted. Me too, which sounds weird because I literally get to know like 200-300 people, new people every year through the podcast, through visiting the conferences and all of that. And actually, conferences are a lot cooler when people come up to you and you don't have to come up to people. And as an introvert, you can probably relate a lot. It's for me near impossible to start a new conversation with someone that I don't know. And I have a very hard time just going up to a person saying hello. Like, let's meet. But I'm super happy if someone comes up to me and they're like, oh, like, hi Robin, like, oh hi, who are you? Then it's better for me if someone already knows me. But it's still so hard for me of like making an introduction. Like it's a whole thing with being introverted. But most Bitcoiners actually, like, there was this study done, like the poll of like Bitcoiners, and they mostly actually are introverted in that regard.
Yeah, like a lot of Bitcoiners have a similar personality type, like the 16 different personality types or whatever. They're, they tend to be introverted, but then also like in a kind of a couple different personality types. I think I can't remember the specifics on it, but I know what you're referring to. Yeah, definitely. I mean, I would say over time I've become slightly more extroverted, but I'm still, my default is very introverted, and I've come out of my shell a bit. But I was a massive introvert in high school, like extremely, ridiculously so. And yeah, it's sports, and that's probably another one of the reasons why I'm so passionate about exercise and sports, is because that was the outlet I felt the most confident in. That was the outlet that I was the most social in. And most of my friends throughout my life have I met through basketball and through sports. And yeah, it's been an amazing gift in many ways, sports and basketball specifically. But yeah, I mean, a lot of, well, I guess like half the population will be able to relate and half the population won't. I don't know what the exact percentage. All the extroverts will be like, what is this guy talking about? Right. I mean, most people that are extroverted, though, they have, someone close to them that's an introvert, and so they can kind of understand a little bit. But it is kind of crazy how different people's personalities are, and how when we look at the world, we assess it through our own lens of our own biology, our own personality, the way we are. And so we assume everyone else is kind of feeling the same, or things come as easy. Like something that seems so difficult for one person is like the easiest thing for another person, and vice versa, right? And so it's good to understand that and remember that. And the other thing is, like, we judge other people, or as a society in general, we judge other people based on our own biology, but nobody knows how difficult it is to be in another person's brain and body. We have no idea what it's like to be another person. We don't know what that person's going through. We don't know how much struggles they have in their internal biology, and how much pain they might be in psychologically or physically. So we judge people and kind of say like, oh, that person shouldn't have acted that way. But we don't know if we wouldn't have acted that exact same way if we weren't in that person's body. And so I don't know. It's just one of those things I try to remind myself, is like, you have no clue how another person's feeling in any moment. And so it's really hard to assess their actions without understanding what's going on internally, because we can't know what's going on internally. It's a whole world that is only accessible to that person. So, yeah, it's again another topic. Mental health is another huge thing, but yeah, basically.
I love that.
Yeah, that was a tough question. Whoever asked that, I mean, I didn't expect that, but at the same time, I was like, man, I hope I did it justice. I definitely. I mean, there were some other embarrassing moments. I'll admit, like, there's probably a couple things there's probably like 2 or 3 things I don't want to share, but but that's the one I can share that is honestly a real like kind of embarrassing / like stressful thing in my childhood. But yeah, there's definitely a few that I won't share. I think most people will most people would probably say the same, but yeah. Do you need me to ask a question for the next person?
We usually do it offline, but
Oh, offline. Sure, let's do it offline. We can do it
but
offline.
if you already have one, like feel free.
No, I don't have anything. I was thinking about it kind of as we were talking a little bit, but I can get you. I'll try to think of something good and I can get it to you offline maybe.
Awesome, man! It's been so good. So just as a few indicators how long these podcasts have been. Usually, my air is still better. Like the air is so bad already in my studio now, and my fiance already had to come in twice to go to the toilet while we have recording, which usually doesn't happen. So that's like two weird indicators of showing how long we have been recording today. It's really, I love it because it's a different kind of conversation, and it almost feels more relaxed and more like in the moment. And we were talking about anything. And so it's kind of the last two questions took us another like 30, 40 minutes now. But yeah, thank you so much for spending so much time on our podcast, on being here with us. But yeah, before I let you go, where can people find you, ask you questions, and yeah, reach out to you?
Yeah, I definitely appreciate obviously the platform and the conversation and just spending this time with you. I it's the longest podcast I've ever done, and I do like long form content myself. Like I consume a lot of podcasts while I'm working. Like I've been doing this for years. It's I mean, there was periods of my life where I had jobs where I would be able to listen to 10 hours of podcast, 8 hours of podcasts a day. So I've listened to all sorts of stuff. And I love kind of like just working and cleaning and doing different things while I'm listening to stuff. So for me, I like longer form, 2-3 hour conversations. It's kind of my preference because you get a different insight into who people are. And I mean, people can kind of pretend to be somebody for 10 minutes, but it's really hard to put that on for multiple hours. So it's, I think a bit more of the personality of who that person is shines through in this longer form. But for myself, the best place to find me is simply on X. I mean, that's where I'm most active. I have it in the image there. I don't know if it'll show up on the recording, but it's at the Real Plan C is my handle on X. So you can search and follow me there if you're so inclined. And I do a weekly show with Mauricio on his channel, which is another YouTube channel. He's got a great channel. Him, me, and Sminston, the guy that we were referring to earlier. We do a weekly show. It comes out every Wednesday, usually in the morning. Comes out every Wednesday. We record it on Tuesdays. And I know that's relative to when everyone, whatever time zone they're in. But yeah, basically I do a weekly show there. And that's usually about 30, 40 minutes. We focus mostly on charts, and it's do a deep dive into kind of somewhat what we did today, but I would say not quite as deep as we went today. We'll cover a few charts and kind of give our opinions, and it's a fun conversation. So yeah, on Mauricio's channel on YouTube or on X, those are the two places you can kind of see me regularly.
Yeah, we did 6 shows today in the 3 hours, kind of. If you break it up, thank you so much, Plan C, for being on the podcast and being such a gracious host, gracious guest with your time and with your insights. And also, yeah, thank you so much for everyone that is sticking around for the first like 3 hour plus podcast that I recorded in 700 episodes. And
this is the longest podcast you've done.
It's the longest one I've done.
Oh my goodness. I don't know.
I think it's like it's about half an hour longer than the second one or something like that.
Oh wow. Okay. Well, that's I guess I didn't know that, but that shows when I get passionate about things, I tend to talk. But yeah, I appreciate anyone that's listening to the whole thing, breaking it up or whatever they're doing. I really appreciate obviously everyone who's listening in, and hope you got something out of it. And hope you can see how passionate I am about these subjects. So.
I think this is very easy to see if you watch the whole 3 hours of Plan C. Thank you so much for being on, and also thank you so much for everyone that is watching and listening for joining us today. As always, I'll be back. This content is for educational and entertainment purposes only and does not constitute financial advice.